Okay. So now we move on to section 80 triple C. Section 80 triple C. This is deduction with respect to investment in annuity plan of Life Insurance Corporation of India or any other insurance company. Who can claim deduction? Individual can claim deduction. Only individual can claim deduction. This is point number one. Point number two, this is deduction with respect to investment made in the annuity plan of Life Insurance Corporation of India or any other insurer. See, annuity plan you have already understood in section 80C. This annuity plan is also similar to that. This annuity plan is also similar to that. Now you may think that if the annuity plan covered by section 80 triple C is similar to section 80C, then why there was a need for section 80 triple C? So let me tell you that maximum limit for deduction under section 80C is 1,50,000. Maximum limit for deduction under section 80 triple C is also 1,50,000, and the combined deduction is also 1,50,000. Plus, once you have claimed deduction for a investment in annuity plan in section 80C, you cannot claim deduction in section 80 triple C. So double deduction will not be allowed. You claim deduction in either 80C or you claim deduction in section 80 triple C. You cannot claim the double deduction. So contribution made to annuity plan of LIC or any other insurer for receiving pension from the pension fund is deductible to the extent of 1,50,000. Point number 3 is very important. It says payment should be made out of income chargeable to tax. So your income can be divided into two categories. Number one, taxable income, and number two, non-taxable income. If you want deduction under section 80 triple C, then your income, then your investment which is made in this annuity plan of LIC should be out of taxable income. If you have earned some exempt income and you are investing money out of exempt income, then you cannot claim deduction. Then deduction will not be allowed. Is that very clear? Yes or no? Okay. So see, this condition is very difficult to check. This can be checked by only one way, by accessing your bank statement. Say for example, you are earning agriculture income as well as non-agriculture income. So in your bank statement, say for example, in the month of April, non-agriculture income is appearing, and you have done the investment in the month of May, and your opening balance was, say for example, 0. Your opening balance in your bank account was 0. You have earned some income in the month of April, that is non-agriculture income, and you have invested money in the month of May. In that case, we can definitely say that whatever money you have invested, that is invested out of taxable income. If you have earned a taxable income in the month of April, but for example, if you have earned only exempt income in the month of April, in the month of April you had only agriculture income, and you invested money in the month of May. In that case, definitely you would have invested money out of your exempt income. In other words, income which is not chargeable to tax. So practically, this condition is very difficult to check. What happened? Swati madam? Okay, okay. Practically, this condition is very difficult to check. But this condition is not appearing in all the sections. It is appearing only in 2 to 3 sections. Section 80C, we did not have such conditions. We are having this condition only in section 80 triple C, and when we proceed further in section 80D, you will find out that we also have a similar condition in section 80D. If you want, you can surrender the pension plan. You can surrender this annuity plan of Life Insurance Corporation of India or any other insurance company. In that case, whatever surrender value you receive, will be totally taxable in the year of receipt. The surrender value will be taxable in the hands of SSC or in the hands of nominee. Say, for example, if you die, the name of the person in whose name this deferred annuity policy is purchased, that person has died. In that case, whosoever is the nominee, he will receive the surrender value, and that surrender value will become totally taxable to the nominee. Point 5 says that if you have invested money in this pension scheme, in this annuity plan, once the tenure of an annuity plan comes to an end, then you would receive the pension from the annuity plan. That pension will become fully taxable. So any pension which you have received from the annuity plan will become fully taxable to you. And since this pension is not received from employer, this is received from insurance company, this will be taxable to you under income from other sources. This will be taxable to you under income from other sources. Point 6 says that you cannot claim double deduction. Double deduction is not allowed. If you have claimed deduction for investment made in the annuity plan in section 80C, then you cannot claim for the same investment, you cannot claim here. For the same investment, you cannot claim deduction here if you have already claimed deduction under section 80C. Point number 7, tax treatment of commuted value. See, this annuity or this pension plan, when you receive the pension, you also have an option to commute this then you are eligible to claim the exemption as per section 10 clause 10. Are you getting my voice very clearly? Yes. See, section 80C and section 80 triple C. Section 80C and section 80 triple C. Actually, section 80C, 80C is an exhaustive section. It is having 23 points. In fact, there was no need for the government to separately make section 80 triple C because this annuity plan of LIC or any other insurance company is anyway covered by section 80C. So over a period of time, government has realized that section 80 triple C is made by mistake. Actually, there was no need to make this section. Therefore, what government has done, instead of deleting the section, government said that your deduction under section 80C maximum limit is 1,50,000. Your deduction under section 80 triple C, there also maximum limit is 1,50,000, and your combined maximum limit for deduction under section 80C as well as 80 triple C would also remain the same at 1,50,000. So whether you claim deduction in section 80C or whether you claim deduction in 80 triple C, it is not going to make any difference. But for the same amount of investment, if you are investing money once, we can definitely give you deduction only once. We will not allow you deduction twice. So for same amount of investment, you cannot claim deduction in section 80C as well as section 80 triple C. Is that very, very clear? Yes, either of it. Either of it only for this pension annuity plan point. For annuity plan point, for the same investment, you can claim you can claim either of this. Next section is section 80 CCD. This is a very important section. This section is having a reference in the chapter of income from salary as well as profits and gains of business profession. So this chapter will be discussing from the point of view of income from salaries chapter, from the point of view of profits and gains of business profession chapter, as well as from the point of view of deductions chapter. So I am having a handwritten note for you. From this handwritten notes only we will understand this section. Okay. Now listen to me carefully. See, all those people who are doing government jobs, after their retirement, they are going to receive pension. All those people who are doing government jobs, after their retirement, they are going to receive the pension. government is paying pension to every employee. But the point is, there are a lot of people, lot of employees, government employees who have retired. So till they are alive, government has to pay pension to them. After their death, government has to pay pension to their family. This pension is the most unproductive expenditure. This you might have heard in the economics as well. So this pension is a most unproductive expenditure. Till the time that government employee is alive, government has to pay pension. This pension amount is so huge that it is taking away huge chunk of government's money. It is having huge burden. All those employees who have joined the government job on or after 1st January 2004 has to mandatorily contribute money to pension scheme also. So now similar to provident fund, there is a pension fund, there is a pension scheme in which employer as well as employee both will contribute money. So earlier employer used to pay money, pay pension out of his own pocket entirely. Now that is not the case because from 2004 onwards, all those people who have joined government job from their salary, some portion of the salary will be deducted as contribution to pension scheme. So now this pension scheme has taken similar form of a provident fund scheme, wherein employer employee both will contribute. So now in case of pension scheme, employee has to contribute, employer will also contribute. This money will be invested somewhere over a period of time. This amount will increase, and after the retirement, government will pay pension out of that pension fund. Have you first of all clearly understood that what is the difference between a provident fund and a pension fund? Yes. So pension scheme was started in the, it was set up in 2003. It started from 1st January 2004. It is mandatory for every government employee to participate in the pension scheme. It is not optional, it is mandatory. So every month, while salary is being paid to the government employee, from his salary, some amount will be deducted as contribution to provident fund and some amount will be deducted as contribution to pension scheme. So this pension scheme was set up in the year 2003. In the year 2016, one more pension scheme was added to this, and that is Atal Pension Yojana. This was started in the name of former Prime Minister of the country. So now in this there are two pension schemes. Number one, new pension scheme. set up in the year 2003, and number two, Atal Pension Yojana. This is set up in the year 2016. Who can join pension scheme? For an individual who is a government employee. For an individual who is a government employee, for him it is mandatory to participate in the pension scheme. So he has to contribute money mandatorily. It is not optional. But any other employee means doing in private jobs. So all those employees who are working in a private organization, in a private sector, for them participating in this pension scheme is not mandatory, it is optional. Now say for example, if at all they participate, in that case employer employee both will have to contribute money to the pension scheme. In that case, employer doesn't normally shell out more money out of his own pocket. What happens is employer will reduce his contribution to the provident fund scheme and part amount he will transfer to pension scheme. But employee has to contribute money out of own pocket to the pension scheme. So for a private sector employee, this scheme is optional. If at all this scheme is set up by the employer, then only he has to contribute, and then only he'll receive the pension after the retirement. For self-employed people also this is optional. So this pension scheme, which was set up in the year 2003, which was started with effect from 1st January 2004, it is mandatory for government employees and optional for private sector employees and self-employed people. If at all private sector employer is participating in this scheme, then his employees would receive the pension after the retirement. Those people who are self-employed may also receive pension after retirement if at all they are participating. Otherwise, they will not receive. Is that very, very clear? Yes? Okay. So now let us proceed to this handwritten notes. In this section 80 CCD, we need to do discussion from the point of view of person who is investing money. This entire discussion is done from the point of view of employee. We'll discuss from the point of view of income from salary chapter as well as deduction chapter. PGVP chapter also I have explained you few points in the chapter of PGVP in section 36 subsection 1. There this pension point is also covered. The contribution to pension scheme, only individual can claim deduction because only individual can do job, only individual can retire, so only individual can claim deduction under section 80 CCD with respect to contribution to pension scheme. This contribution is divided in two parts. Number one, employee's own contribution. We are not writing the word employee because even a self-employed person can contribute money to this scheme. So we are writing individual's own contribution. So you can consider that if the person is doing a job, then this would be employee's contribution. And number two, we also have employer's contribution. So we need to discuss what would be the treatment of employee's contribution and what would be the treatment of employer's contribution. And this treatment we are discussing from the point of view of employee. First of all, employee contribution is what for employee? Employee's contribution is what for employee? Employee's contribution is an investment for employee. Employee contribution is an investment for employee. So he can claim deduction for that investment. Government has given incentive to him saying that we are going to give you deduction. For that deduction, government has made two sections, section 80 CCD subsection 1 and section 80 CCD subsection 1B. See, in the chapter of PGBP, if you recollect, we had two types of depreciation, normal depreciation and additional depreciation. So here also you can claim deduction. This deduction is divided in two parts, normal deduction and additional deduction. Normal deduction is allowed in section 80 CCD subsection 1 and additional deduction is allowed in section 80 CCD subsection 1B. So deduction is divided into normal and additional. We are talking about whose contribution? We are talking about own contribution. If it is a self-employed person, then there will not be any employer. and if person is doing job, then your own contribution means employee's contribution. So first of all, let's move on to section 80 CCD subsection 1. See, this section 80 CCD is basically having three subsections: subsection 1, subsection 1B, and subsection 2. There are three subsections: subsection 1, subsection 1B, and subsection 2. Subsection 1 and subsection 1B, they are giving deduction for employees' contribution, whereas subsection 2 is given deduction for employer's contribution. So if a person is self-employed, then there won't be any employer contribution, so there won't be any deduction in section 80 CCD subsection 2. Have you first of all understood the number of subsections and which subsection is giving deduction for whose contribution? Yes? Okay. So now let's move on to understand what is the treatment for contribution made by an individual to this pension scheme. That is employees' contribution. This is divided in two parts: section 80 CCD subsection 1 and section 80 CCD subsection 1B. First of all, 80 CCD subsection 1 says deduction will be allowed for investment made in the pension scheme subject to the maximum limit. Subject to the maximum limit. There is a maximum limit which is applicable. In case of people who are doing job, there is a separate maximum limit which is computed based on salary amount, and people who are self-employed, for them there is a separate maximum limit which is calculated based on total income. So if you are an employee, if you are doing job, then for you maximum limit is 10% of salary. For you maximum limit is how much? 10% of salary. And what do you mean by salary? Salary means that same old definition: basic salary, DA recognized, and turnover commission. Is that very is that very clear? So actual deduction will be how much? Amount contributed or maximum limit, whichever is lower, will be allowed to as deduction. Amount contributed to the pension scheme or maximum limit 10% of salary, whichever is lower, will be allowed to as deduction if you are an employee. What if you are a self-employed person? In that case also, your deduction will be lower of following two amounts. Number one, actual amount contributed, and number two, maximum limit. What is the maximum limit in that case? Maximum limit is 20% of total income. Maximum limit is 20% of total income. Now the question is, what do you mean by total income? In the chapter of salary as well as here, if a person is doing a job, then the limit is basic salary, DA recognized, turnover commission. These three components are taken, and then we calculate 10% of that amount. Similarly, in case of self-employed person, also there is a limit. How much is the limit? 20% of total income. But what do you mean by total income? That is also defined. Total income means you take up the amount of gross total income. From that, you deduct the long-term capital gain. You also deduct the short-term capital gain, which is covered by section 111A. So it is gross total income excluding long-term capital gain under section 112, excluding long-term capital gain covered under section 112A, excluding long-term capital gain covered under section 111A. You deduct this amount, the balance amount will be called as total income. Of that total income, you take out 20%. You take out 20%. That you compare with the actual contribution, whichever is lower will be allowed to as deduction. Have you understood this maximum limits? Yes or no? So these limits are applicable in case of person doing job, salaried employee, limit is 10% of salary. In case of self-employed person, limit is 20% of total income. Now you may think that why higher limit is given to those people who are self-employed. In case of employee, it is only 10% of salary. In case of self-employed people, why 20% of total income? Why double the limit? So few years back, here also it was 10% of total income. Just 3-4 years back, here the limit was 10% of total income. Now it is increased to 20% of total income because few people argued that in case of employee, if person who is doing a job, in case of employee, he can claim deduction for his own contribution as well as his employer's contribution. And the limits are 10% for each contribution. So if you are doing a job, then for your own contribution, you can claim deduction to the extent of 10% of salary, and whatever amount your employer is contributing, for that also you can claim deduction of 10% of salary. So on an overall basis, a person doing job is getting 20% deduction. Whereas in case of people who are self-employed, there is no employer. Only they are contributing to the scheme. In that case, if you allow 10% deduction to them, then there would be a discrimination between those who are doing job and those who are self-employed. Actually, both should get the equivalent deduction. Therefore, to match the deduction available to these both individuals, government came out with a budget amendment and government increased the percentage from 10% to 20% in case of self-employed people. Yes, have you understood this much? Have you understood the reason behind different percentages? Okay. So this was deduction under section 80 CCD. This was deduction for own contribution. If you are working as an employee, then employee's contribution. We have one more section for deduction in case of deduction for employees' contribution. That is under section 80 CCD subsection 1B. That is under section 80 CCD subsection 1B. This is additional deduction in case of employees' contribution. Additional deduction means over and above what is allowed in section 80 CCD subsection 1. What is the quantum of additional deduction? Here there is a maximum limit of 50,000 rupees. Here there is a maximum limit of 50,000 rupees. So extra deduction over and above what is allowed in section 80 CCD subsection 1, you can claim deduction for extra amount, and that is to the tune of 50,000 rupees. Yes, is that very clear? Okay. Now, if you see here in section 80 CCD subsection 1, here I have written own contribution more than 50,000. Own contribution more than 50,000. Why more than 50,000? If it is up to 50,000, then you go and claim deduction in section 80 CCD subsection 1B. If the amount is more than 50,000, then you come to section 80 CCD subsection 1. So first you go and claim deduction in section 80 CCD subsection 1B if the contribution is up to 50,000 per annum. If the contribution is more than that, then you go to section 80 CCD subsection 1 for claiming deduction. Why so? That we will discuss further. When we discuss further, once we complete this section, we will understand the overall maximum limit for section 80C plus section 80 CCC as well as section 80 CCD. At that point of time, I'll make you understand why we should claim deduction in section 80 CCD subsection 1B first, and then we should go for section 80 CCD subsection 1. That point I'm keeping pending right now. So this left hand side, employees contribution or individual's contribution is over. Now we are moving on to right hand side, that is employer's contribution. That is employer's contribution. First of all, you tell me, this discussion which we are having from whose point of view? This discussion is from employer's point of view or employee's point of view? Yes? This discussion is from employee's point of view. So the next question is, employer's contribution is what for employee? Employer's contribution is what for employee? When employer is contributing money to this fund, this amount contributed by employer to the fund should be considered as what for employee? Number 1, investment. Number 2, income. Number 3, expense. Number 4, liability. Yes? Okay. If you are saying investment, then let me ask you the same question in respect of provident fund. When employer is contributing money to provident fund, if employer is contributing money to provident fund, that employer's contribution to provident fund is what for employee? Employer's contribution to provident fund is what for employee? Yes. Employer's contribution to provident fund is an income for employee. So if employer contribution to provident fund is an income of employee, then employer contribution to this pension scheme should also be income of employee. This should also be income of employee. So employer contribution to provident fund is an income of employee, and employer contribution to pension scheme is also an income of employee. So first of all, first effect will be given in the chapter of income from salaries. First effect will be given in the chapter of income from salaries. So whenever employer is contributing money to pension scheme, whenever employer is contributing money to pension scheme, that employer's contribution is considered as income of employee, and that is fully taxable in the hand of employee, and that is given in section 17 subsection 1. That is given where? Section 17 subsection 1. I'll show you that page of income from salaries chapter. It is given on page number 39. Page number 39 of your notes. See this. Section 17 subsection 1 defines the salary to include following. In that case, we have point number 9. Contribution made by employer to the account of employee under pension scheme referred to in section 80 CCD. This point we have not discussed in the chapter of income from salary. We had kept aside. So now we have discussed, saying that employer contribution is an income for the employee, and this is fully taxable in section 17 subsection 1. Yes, have you understood this point? Yes. So we are discussing about employer's contribution to pension scheme. Step number 1, this employer contribution is an income of employee. So first of all, it should be taxable under that income from salaries. And number 2, that same amount of employer contribution is also is also allowed as deduction to the employee. It is also allowed as deduction to the employee. See, in case of provident fund, exemption is allowed. In case of pension fund, deduction is allowed. Exemption is allowed means that portion will not be taken into the employee's income at all. The amount which is exempt will not be taken into employee's income. Whereas when we say deduction, meaning thereby entire employer's contribution will be taken into employee's income, thereafter deduction will be allowed as per the rules. That is the reason that I have told you that step number 1, you add the entire amount to income from salary, and then for the same amount you claim deduction under section 80 CCD subsection 2. Where you will claim deduction? Section 80 CCD subsection 2. See, for employee's own contribution, he is claiming deduction in section 80 CCD subsection 1 and section 80 CCD subsection 1B. For employer contribution, employee is claiming deduction. Now you may think, why employee is claiming deduction for employer's contribution? Because first of all, that amount is entirely made taxable to him under that income from salary. That is the reason we are allowing him deduction in section 80 CCD subsection 2. Yes, is that very, very clear? Now, is there any maximum limit for claiming deduction? Yes. Deduction will be lower of following 2 amounts. Number 1, actual amount contributed by employer. Number 1 is what? Actual amount contributed by employer. And number 2 is maximum limit, which is 10% of salary. Number 2 is maximum limit, which is 10% of salary. What do you mean by salary? Salary equals to basic salary, DA recognized, turnover commission. Salary equals to basic salary, DA recognized, turnover commission. So employee can claim deduction twice, once for his own contribution and once for amount contributed by employer. Both the limits are same, 10% of salary. So on a overall basis, employee would get how much deduction? To the extent of 20% of salary. To the extent of 20% of salary. Yes, is that very, very clear? Yes, okay. Now listen to me very carefully. I'm going to ask you a very simple question. You have to answer me that question. Uh, I told you that this scheme was started in the year 2004. It is mandatory for government employee to participate in this scheme. So my question to you is, this scheme is mandatory for those government employees who have joined the government job on or after 1st January 2004. What about those who had joined the government job prior to 2004? They are not within this scheme. So therefore, for those employees, government will pay pension out of their own pocket after the retirement. So my question is, those employees who have already joined government job prior to 2004, they are not going to contribute any money. They are not going to contribute any money, and government is going to pay them pension out of their own pocket. So point is, who is at a beneficial position? Those employees who had joined the government job prior to 2004, they are at a beneficial position, or those who have joined the government job on or after 1st of 2004, they are at a beneficial position. Definitely, those who have joined the government jobs prior to 1st of 2004. Those who have joined government jobs prior to 1st of 2004. Because they will get pension without contributing anything. They will get pension without contributing anything. So all those employees who have joined the government job on or after 1st January 2004, they don't like this pension scheme because every month they have to contribute money from their own pocket. So every 2-3 years, once in every 2-3 years, these new employees who have joined the government job on or after 1st January 2004 will go on a strike saying that you cancel this scheme and you put us into that old scheme only. We don't want this new scheme because employee has to contribute in this new scheme. In the old scheme, employee was not contributing at all. Government was paying pension out of its own pocket. Therefore, this new scheme is not liked by the new employees. So recently, just 2 years back, all the central government employees, state government employees, they went on a strike saying that please cancel this scheme. We don't want the benefit of this scheme. You put us in the old scheme only. Instead of instead of canceling the scheme, government said that we will increase our contribution to the scheme. Instead of canceling the scheme, central government said that we will contribute more amount. So instead of 10%, central government started contributing 14%. Instead of 10%, central government started contributing 14% of salary to the pension scheme. So now central government is contributing 14%, and this entire 14%, whatever amount is contributed by the central government, should be taken to employees' income from salary. And for that same amount, he can also claim deduction. So the limit which you have seen here, maximum limit for deduction of employer's contribution in section 86 subsection 2. This limit is 10% of salary, but in case of government employee, this limit is 14% of salary. In case of government employee, this limit is increased to 14% of salary because government has also increased its own contribution. Government's contribution is also 14% of salary, and government has also increased the deduction limit. So here in this handwritten notes, that point is missing here. That point is missing here. So once I send you the handwritten notes, you should, if you're taking printout, then you should write that point here. Here that is written on page number 289 in your book. Oh, sorry, 285. Page number 285. Point number 6. Section 80 CCD, subsection 2. Deduction for employers' contribution to pension scheme. Deduction will be allowed subject to the limit of 10% of salary. However, in case of government employee, deduction limit would be 14% of salary. Yes, have you understood this much? Yes or no? Sarvana is asking me, sir, employee will also contribute 14%. Employee can contribute 14%. If he wants to contribute less, he will contribute less. But generally, everyone is contributing 10% only, because for employees, contribution deduction is restricted to 10% of salary. In case of government employee, that is what I am telling you, that in case of government employee, employees are contributing 10% only. And the deduction limit for employee contribution is also 10%. The limit is increased from 10% to 14% only when the employee is government employee, and that limit is only for employer's contribution, not for employee's contribution. Vishnu is asking me, sir, this point is applicable only to government employee or all employees? Central government employees only. Central government employee. This point is applicable in case of central government employees. Vishnu, is that clear? Okay. So let me ask you a question before we actually proceed further. Let me ask you a very simple question. This entire discussion which we had, this is from whose point of view? Yes. This is from employee's point of view. This is from employee's point of view. Number two question, employee can claim deduction for whose contribution? He can claim deduction for his own contribution, he can claim deduction for employer contribution, or he can claim deduction for both. Answer is definitely both. Answer is definitely both. Employee can claim deduction for his own contribution in section 80 CCD subsection 1 and section 80 CCD subsection 1B. And employee can also claim deduction for employer contribution under section 80 CCD subsection 2. Yes, is that very, very clear? Why deduction is allowed to employee for his own contribution? Because he is making investment and government wants to give incentive for making an investment. Why deduction is allowed to employee for employer's contribution? Because that amount is first of all considered as an income of employee. That amount is entirely first of all considered as an income of employee. So entire amount is added to employee's income. Thereafter, he can claim deduction. Now, let me tell you similar point in section 80C also. In the chapter of income from salary, I had taught you one point. In fact, I am not telling you that point. I will ask you a question. If employer is paying life insurance premium of employee, if employer is paying life insurance premium of employee, then what is the treatment? What would be the tax treatment? Yes, what would be the treatment in the chapter of income from salary? If employer is paying life insurance premium of employee, what would be the tax treatment in the hands of employee? Deva and Vishnu have given me the answer saying that, sir, it is exempt from tax. Are they correct? It is taxable or it is exempt? Yes. Employer has paid the life insurance premium of employee. That amount is taxable to employee or it is exempt to employee? It is fully taxable in section 17 subsection 2 clause 5. It is fully taxable in section 17 subsection 2 clause 5. Those who do not remember, then go can go to the chapter of income from salary on page number 36. Those who do not remember this point can go to the chapter of income from salary on page number 36 of your notes. Your section 17 subsection 2 clause 5 you are having life insurance premium contribution to deferred annuity scheme. This is considered as perquisite. It is fully taxable in the end of employee. See, don't get confused with health insurance premium. If employer is paying health insurance premium, that is exempt in the hands of employee. If employer is paying life insurance premium, that is fully taxable in the hands of employee. Yes, is that very, very clear? Those who are saying the answer is exempt, have you got this point? If employer is paying your life insurance premium, that is fully taxable in section 17, subsection 2, clause 5. And if employer is paying health insurance premium, that is totally exempt from tax. And that was taught to you while discussing perquisite with respect to medical facility. That was taught to you while discussing perquisite with respect to medical facility. Now, let me ask you one simple question. Employer has paid life insurance premium of employee. That life insurance premium is added to employee's income. That life insurance premium is added to employee's income. Can employee claim deduction for that under section 80C? Can employee claim deduction for that under section 80C? Do you remember now in section 80C we have first part in first point itself you can claim deduction for life insurance premium paid. So the question is if life insurance premium is paid by employee, sorry, if it is paid by employer, it is fully taxable in the hands of employee. For that amount, can employee claim deduction in section 80C? Answer is yes, he can. Answer is yes, he can. This is very, very important point. That is the reason I have asked you a question. And now I am trying to connect that point with this section 80 CCD. See, here in section 80 CCD, for employer contribution, we gave two effects. Number one, first of all, it was fully taxable under the income from salary. And number two, thereafter, deduction was allowed in section 80 CCD subsection 2. Similarly, if employer is paying life insurance premium of employee, if employer is paying life insurance premium of employee, in that case, whatever premiums paid by employer will become fully taxable to employee in section 17 subsection 2 clause 5 and same amount can be claimed as deduction under section 80C. Yes, is that very, very clear? I have tried to compare section 80C life insurance premium point with section 80 CCD. What is the common thing in both? In both places, employer are contributing. In both places, these amounts are fully taxable to employee under their income from salary. In both places, employee can claim deduction. For life insurance premium, he can claim deduction in section 80C, whereas for employer's contribution to pension scheme, he can claim deduction in section 80 CCD subsection 2. Manoj is asking me question, but that limit of 1,50,000 is applicable? Answer is yes. That limit of 1,50,000 is applicable to entire section 80C. All 23 points combined. Yes, is that very clear? Yes, okay. So we have done the discussion with respect to employee as well as employer's contribution to notified pension scheme. We have done the discussion with respect to that. Now, let us move on to second part of the discussion. Employer paid life insurance premium can claim deduction under section 80C. Sarvana is asking me question. Employer has paid a life insurance premium. Sarvana, what is your question? Can employer claim deduction? That is the question. Or can employee claim deduction? No, this you are asking from whose point of view? Employee or employer? Employee. Oh, that's what I told you now. That's what I explained you right now, saying that whatever insurance premium paid by employer, I was talking till now I was talking about the same thing. I was not talking about insurance premium paid by employee. I was talking about the insurance premium paid by employer. Life insurance policy is taken for employee. Premium is paid by employer. This premium is an expenditure for employer, income for the employee. Since it is an expenditure for the employer, he will claim deduction while computing his business income. Since it is an income of employee, it is taxable to him as per section 17 subsection 2 clause 5. It is fully taxable to employee in section 17 subsection 2 clause 5, and that same amount he can also claim it as deduction. That same amount he can also claim it as deduction in section 80C. Have you now understood very clearly? Okay, let us now proceed further with respect to our discussion. This section 80CCD, we have discussed the tax treatment of employees' contribution as well as employer contribution, and this discussion is entirely from the point of view of employee. Now we move on to second part of our discussion. After the employee retires, he is going to receive pension from this scheme. Will that pension become taxable? After the retirement, employee will receive monthly pension. Will that become taxable? Answer is, if he was doing a job, then whatever pension he is receiving, he will receive from employer. In that case, it is taxable under income from salary. Whereas, if that person was a self-employed person, in that case, he is not receiving a pension from his employer because there is no employer. He is receiving pension from this notified pension scheme. That pension will become taxable to him under the head income from other sources. So whatever monthly pension is received from this pension scheme is fully taxable under income from other sources. Have you understood this point number 1? Yes or no? Yes, very good. Now let's move on to point number 2. For example, employee feels that this pension scheme is not so beneficial. This pension scheme is not so beneficial. Let me opt out of this pension scheme. Then employee will stop contributing to the pension scheme. Whatever balance is lying in the account, he will withdraw money and he will close the account. If you are a self-employed person and if you feel that the return which is offered by this notified pension scheme is very less, then you can opt out from this section. You can opt out from this pension scheme. You can close your account. If you close your account, whatever balance was lying in the account will be given to you. What is the tax treatment in case you have closed the account and you have withdrawn money from the pension scheme? Bhaskar, what you are writing here? Oh, I think, have you logged in the Zoom in 2 different sessions? Are you also simultaneously talking to your girlfriend? What is the meaning of this? Is it a song? Oh, Seri Seri. I thought either you were sending the message to your girlfriend. By mistake, you have sent message to me in this group. So, okay. I need to learn this basic Tamil now. Okay, let's proceed. So I was telling you that if you feel that this scheme is offering very low return, then you can close the account and withdraw money from the scheme. If you withdraw money, what would be the tax treatment? If you withdraw money, what would be the tax treatment? Whatever amount is withdrawn, 60% amount will be exempt from tax. Whatever amount is withdrawn, out of that, 60% amount will be exempt from tax. Here I have written 40% because this is old notes. These notes are old notes. If I get that notebook, I will change this and send it to you. I'll send you the new copy. If at all I send you the old copy, you should remember that here there was a budget amendment. This percentage was increased from 40% to 60%. So whatever amount is withdrawn from the scheme at the time of closure of the account, 40% of the amount was exempt from tax earlier. Now this is amended. Now onwards 60% is exempt. In the notes I have written 60% only. See this. Amount received by the SSC on closure of his account or opting out of NPS scheme. Exemption is under section 10 clause 12A up to 60% of the total amount payable to him at the time of closure of the account. Balance 40% is taxable. This exemption is increased from 40% to 60% by budget 2019. So the notes, handwritten notes which you are seeing on the screen, these are old notes. So that is the reason this percentage is not amended here. So this percentage is 60. 60% amount is exempt from tax in section 10 clause 12A. Balance 40% will become taxable. Balance 40% will become taxable. Have you understood this very clearly? Yes or no? Now listen to me very carefully. This section 10 clause 12A, when this section was introduced for giving exemption, this section was giving exemption only to employee subscriber to the scheme. This section was giving exemption only to employee subscriber. If a self-employed person is subscribed to the scheme and he is closing his account, he is withdrawing the entire amount, then he was not offered any exemption. In his case, entire amount was being taxed. Therefore, to provide a level playing field, similar treatment to self-employed persons also, government came out with an amendment in the budget saying that this section exemption can be claimed even by the self-employed people. So exemption is now available to employee subscriber as well as non-employee subscriber. This was amended with effect from 2018. Before 2018, only employees were claiming exemption. Non-employee, those people who are self-employed, they were not claiming, they were not allowed to claim any exemption in section 10 clause 12. Is that very clear? So we have completed this point number 2. Once again, I am telling you this 40%, this is old note, therefore it is 40%. This exemption has increased to 60% and taxable amount is reduced from 60% to 40%. Now let's move on to the last 2-3 points. We have discussed the 2 points till now. Now I am moving on to point number 3. Taxability on partial withdrawal from NPS. See, partial withdrawal and full withdrawal. There are 2 types of withdrawal. Full withdrawal means total withdrawal. Total withdrawal means you have closed the account. You have withdrawn entire money. Now you don't want to contribute anything to this scheme. Rizwan, government employees, they are generally government employee will not opt out from this scheme. For them, it is mandatory only. Those employees who are working in private sector, for them anyway it was optional. So if they have opted and thereafter After 3-4 years, if they feel that there is no point of contributing any money in this scheme because this is offering very low returns, in that case, if they want, they can close the account and opt out from the scheme. Government employee will not opt out from the scheme. For him, it is mandatory to stay in the scheme. Okay. Now, there are two types of withdrawal from the pension scheme account. Number one is full withdrawal, also called as total withdrawal. Total withdrawal means you have closed the account. Now you don't have any intention to deposit money in this scheme. In that case, treatment will be given as per point number 2. In that case, treatment will be given as per point number 2. Point number 3 is applicable only when you are interested in this scheme. In future, you want to contribute, but right now you are in dire need of money. Say, for example, some of your family member is hospitalized and you are in need of money. In that case, instead of closing the entire notified pension scheme account, you would like to withdraw some amount. In that case, you can withdraw money from this national pension scheme, notified pension scheme, and in that case, government is offering some exemption also. How much exemption is offered? 25% exemption is offered, but this 25% is of the amount contributed by employee. So whatever amount is withdrawn now, that is required to be bifurcated in 2 parts: employee's contribution, employer's contribution. This deduction will be allowed. This exemption will be allowed in section 10 clause 12b only for contribution made by employee. Only for contribution made by employee. Is that very, very clear? So, if someone has opted to withdraw from the NPS scheme partially, then what will become exempt in section 10 clause 12b is 25% of amount contributed by employee will be exempted. What about balance 75%? That will become taxable. What about the employer's contribution? That will also become taxable. When you withdraw money from the scheme, that amount would consist of employee contribution as well as employer contribution. So that amount withdrawn should be divided in 2 parts: employee contribution, employer contribution. Whatever is employee contribution, out of that 25% will be exempt, 75% will be taxable. And whatever is employer's contribution will become fully taxable. Yes, is that very, very clear? And the most important part of this section 10 clause 12a section 10 clause 12b exemption is this exemption is available only to employee subscriber. In other words, this exemption is not available to non-employee subscriber. This is still a discriminative point. This point is making a discrimination between those people who are doing job and those who are self-employed. I told you that in point number 2 also, whatever exemption was offered, initially it was offered only to employee subscriber, but in budget 2018, government has amended the provision. Now the exemption is available even to non-employee subscriber. But similar amendment is not carried out in section 10 clause 12b. This amendment is carried out only in section 10 clause 12a. In 12b there is no amendment. So in 12b, as of now also, as of today also, only employee subscriber can claim deduction. Non-employee subscriber cannot claim deduction. Have you understood this point? Distinction between section 10 clause 12a and section 10 clause 12b. This is a discriminative point. In my opinion, government should come out with an amendment here also, saying that this exemption will also be available to non-employee subscriber. In other words, it will be available to both. That amendment is long due. In fact, government should have amended in the year 2018 only, but unfortunately they have not amended. So if you partially withdraw from the scheme, and if you are a self-employed person, you will be at a losing end, because in that case you will not get any exemption, entire amount will become taxable to you. So this was point number 3. Next is point number 4. Say for example, the person in whose name this pension scheme is taken, person in whose name this pension scheme is taken, that person has died. In that case, amount will be received by his nominee. Amount will be received by his nominee, and whatever amount is received by nominee will be totally exempt from tax. Whatever amount is received by nominee will be totally exempt from tax. Is that very, very clear? Yes? Shall I proceed? Yes. Let us move on to point number 5. Point number 5 says what? Point number 5 says, if amount is received in point number 1, 2, and 3, see, Rizwan, which point you are talking about? Tell me the serial number. Rizwan, are you talking about point number 3? Okay. Point number 3, if you withdraw, that is taxable. If you are a non-employee subscriber, it is taxable under income from other sources. If you are a non-employee subscriber, that would be taxable to you under income from other sources. If you are an employee subscriber, that can be taxed under income from salaries. Yes? Shall I proceed? Now see, I'll once again go back to point number 1, 2, and 3. See, this point number 1 says whatever pension is received from this scheme is fully taxable. Point number 2 says if you have closed the account and you have opted out of the scheme, then 40% amount will become taxable. Point number 3 says in case of partial withdrawal by the employee, 25% of employee's contribution will be exempted, balance is taxable, and employer's contribution is fully taxable. So in case of point number 1, 2 as well as 3, certain amount is made taxable to you. Certain amount is made taxable. Now if you don't want to pay tax, in point number 1, 2 as well as 3, certain amount is made taxable. But if you don't want to pay any tax, in that case, you can invest that much amount of money in acquiring an annuity plan. You can invest that much amount of money in acquiring an annuity plan. In that case, that amount will not be taxed. So in point number 5, we are saying that if the amount received in point number 1, 2, and 3 is utilized for purchasing annuity plan in the same year, if the amount received in 1, 2, and 3 is utilized for purchasing annuity plan in the same year, then that will be exempt from tax. So whatever amount is made taxable to you, if you want to save tax on that amount, you invest that amount in acquiring the annuity plan. In that case, that will be exempt from tax, nothing will become taxable. Yes, point number 5 is very clear. Okay, let's move on to point number 6. Point number 6 says, if some amount was getting taxed to you in point number 1, 2, and 3. Sarvana is asking me, sir, what do you mean by annuity plan? Sarvana, annuity plan is nothing but annuity scheme. I had explained you in the last lecture, na? Annuity scheme means you have to contribute money for few number of years. For few years, you will have to contribute money to that scheme. Once the tenure of the annuity plan or the tenure of the annuity scheme expires, you will go on receiving money from that scheme. Do you recollect? While discussing section 80C, I had explained you annuity plan. Yes, same it is. Deferred annuity plan are same only. So whatever amount is being taxed to you in point number 1, 2, and 3, if you don't want to pay tax on that, then you invest that amount in annuity plan. In that case, whatever amount you have invested, that will become exempt. In future, you will receive annuity from this plan. You will receive annuity or pension from this plan. Which plan? Annuity plan which you have purchased for saving the tax. From that annuity plan also, in future you are going to receive pension, and that pension will become fully taxable. That pension will become fully taxable. Have you understood this? With this, I have completed the discussion of section 80 CCD. Have you understood this? Yes or no? Okay. All these things are written in point number 7. All these things, they are written here in point number 7 on page number 285. Point 3 point, which section is exempt? Same section. If you do investment, then nothing is taxable. Exemption, same section. Yes, shall I proceed? Rizwan is asking me, sir, annuity plan is purchase deduction in section 80C. Rizwan, if something was made taxable to you in point number 1, 2, and 3, if something was made taxable to you in point number 1, 2, and 3, for saving tax on that, if you have invested money in annuity plan, then for that you cannot claim deduction in section 80C, because for that we have already given you exemption. Rizwan, have you understood this? We cannot give you exemption as well as deduction both na, for the same thing. For the same thing, we cannot give you exemption, deduction both. Just for saving tax, if you invest money in annuity plan, whatever amount you have invested, that is not taxable. Then we say that in point number 6, we are saying that whatever annuity plan you might have purchased in point number 5, from that plan, if you are receiving annuity or pension, that will be totally taxable. This is explained to you in section 80 CCD in point number 7. Section 80 CCD, there are different points. Number 1, what is national pension scheme? Number 2, who can join NPS, national pension scheme? Number 3, who can claim deduction in section 80 CCD? Then we have section 80 CCD subsection 1, subsection 1B, subsection 2. Thereafter, we have point number 7. This talks about amount withdrawn from the pension scheme. Point number 8 talks about no double deduction. For whatever amount you have claimed deduction in section 80C, for that same amount you cannot claim deduction in section 80CCC. Now we are moving on to the most important discussion. Most important part we are discussing here. Now you listen to me very carefully. Because CA Institute, just before 2 years, it was doing something else. Right now it is doing something else. And whatever they were doing just before 2 years, that is now being offered as an alternative solution. So one very important point is involved here. So please concentrate. See, what is the maximum limit for claiming deduction in section 80C? It is 1,50,000. It is 1,50,000. What is the maximum limit for claiming deduction in section 80CCC? What is the maximum limit for claiming deduction in section 80CCC? Same 1,50,000. Same 1,50,000. What is the limit for deduction in section 80 CCD subsection 1? What is the limit for deduction in section 80 CCD subsection 1. If the person is doing a job, 10% of salary. If the person is doing job, then 10% of salary. If person is self-employed, then 20% of total income. Whichever is applicable. If you are doing job, 10% of salary. If you are self-employed, 20% of total income. That is deduction under section 80 CCD subsection 1 for employees contribution. Subsection 1B. That deduction will be allowed to what extent? 50,000 rupees. 50,000 rupees. Then we have section 80 CCD subsection 2. Then we have section 80 CCD subsection 2 deduction for employer's contribution. For employer contribution, employee can claim deduction. Is there any maximum limit? Yes, in case of central government employee, 14% of salary. Other cases, 10% of salary. Have you understood the limits in all these 5 different points? Yes. Now, let me tell you there are 5 points. Section 80C, 80 triple C, 80 CCD subsection 1, 80 CCD subsection 2, and section 80 CCD subsection 1B. Now we are in section 80 CCE. We are in which section? We are in section 80 CCE. Here we are saying that the combined deduction in section 80C plus section 80 triple C plus section 80 CCD subsection 1. Out of 5 points, the combined deduction in 3 points. Which are those 3? 80C, 80 triple C, 80 CCD subsection 1. The combined deduction in all these 3 points should not exceed 1,50,000. Combined to be noted. Very important point to be noted is, can you tell me, in fact, so yes, 2-3 people have answered me saying that 1,50,000, the limit which is given in section 80 CCE does not cover section 80 CCD subsection 1B. It also does not cover section 80 CCD subsection 2. So, point is, for deduction under section 80 CCD subsection 1B and subsection 2, you are going to get extra deduction. Extra deduction means over and above the limit of yes. Yes, please respond. Yes, you have understood? Okay. Can you see the word file on the screen? I'll give you one example to make you understand. Give me 1 minute's time. I'm searching for that example. I'm already having. Give you some numbers. See, section. So there are five. Tell me. Section 1B. Yes or no? Now my point is where you should claim deduction first. Point is where you should claim deduction first. Should you claim in section 80 subsection 1 first, or should you claim deduction in 80 subsection 1B first? Have you understood the question? Most of you are saying that we should claim deduction in section 80 subsection 1B first. Question is, why do you feel so? What is your thinking behind this? lakh 50? Yes or no? Are you understanding? Then it is exhausting our limit from this 1 lakh 50 now. Deduction for this 50,000. So now for this 50,000, you cannot go to section 86 subsection 1B. Are you understanding? Yes or no? Instead of this, if you just change the section in which you are claiming the deduction, you can claim more deduction. If you just change the section, you can claim more deduction. For example, let me take one more example. Example number 2. This 50,000 you are claiming deduction in section 86 subsection 1B. In that case, you are not claiming in section 86 subsection 1. In that case, your aggregate will be 2 lakh 40. In that case also, your deduction will be restricted to 1 lakh 50 only. So in this case, total deduction will be how much? 1 lakh 50 plus 50, that is 2 lakhs. Yes or no? Are you understanding this? So here in the example 1, total deduction would be 1 lakh 50 only. In example 2, total deduction would be 1 lakh 50 plus 50 equals to 2 lakhs. So now the question is, first you should claim deduction in section 80 CCD subsection 1, or first you should claim deduction in section 80 CCD subsection 1B. Where you should claim deduction? Definitely first you should claim deduction in section 80 subsection 1B. Now listen to me carefully. I am telling you important point. See, just before 2 years, now, just before 2 years, CA Institute was following the second example approach, wherein CA Institute while making the solution, they used to claim deduction in section 80 subsection 1B first, and then for extra contribution, they used to go for section 80 Now what CA Institute has done now? Now CA Institute is first claiming deduction in section 80 subsection 1 first, and then 1B thereafter. And thereafter they are giving you alternate solution. Thereafter they are giving alternate solution. In alternate solution, they are mentioning that SSC can claim deduction in section 80 subsection 1B first, and then he can claim for balance in subsection 1 first. Then for balance he can claim in section 80 subsection 1. So now CA Institute is in a confused state of mind. So they feel that both opinions are correct. So in my opinion, for all the practical purposes, if there is a confusion with respect to interpretation of law, then we should interpret in the manner it is beneficial to the taxpayer. And definitely, as explained in example number 2, if you claim deduction in section 80 subsection 1B first, and only for the balance if you go for section 80 subsection 1, that would be more beneficial to the SSE. Therefore, we should claim section 80 subsection 1B first, and then balance we should claim deduction in section 80 subsection 1. Have you understood this very clearly? In ICI module, you are having question on this. I am having one question in my book. ICI module also they are having some question. In my book answer will be different. In ICI book answer will be different, because I have followed the second approach. ICI is following the first approach, and alternative solution they are giving second approach. In my opinion, we should follow the second approach only, because it is, in that case we will save more tax. Yes, is that very clear? Shall I proceed? Okay. So here I have written deduction under section 80 subsection 2 for employer's contribution to notified pension scheme is not covered in the limit of 150 mentioned above. Is not covered in the limit means you are going to get extra deduction for that. Note 2 I have written additional deduction up to 50,000 on payment in excess of 10% under section 80 subsection 1B for individuals contribution or employees contribution to notified pension scheme. That is also not covered in the limit of 1,50,000 mentioned above. Yes, is that very clear to you? So let us move on to question number 1. Let us quickly move on to question number 1. We'll complete this question number 1, and then 9 o'clock we need break now for breakfast. Saap tingla break na. Yes. So we'll have a break at 9 o'clock. Question number 1. Mr. X, age 26 years, is employed by central government in the Ministry of Labor. Date of joining employment is 6th March 2017. So definitely he has to mandatorily contribute money to the pension scheme. It further says during the previous year 2021, his basic salary, including dearness allowance, is 1 lakh per month. His basic salary, including dearness allowance, is how much? 1 lakh per month. Government contributes 15% of his salary towards the notified pension scheme. Government contributes 15% of his salary to notified pension scheme. Matching contribution is made by the employee. Matching contribution is made by the employee. Matching contribution means equal amount is contributed by employee. He annually contributes 70,000 to the public provident fund. For this, he can claim deduction in section 80C. Income of Mr. X from other sources is 1,46,000. So income from other sources amount is directly given to you in the question. Further, it says he is eligible for deduction under section 80CCC for 12,000 rupees. Under section 80CCC, he is eligible to claim deduction for 12,000 rupees. Compute the income of X for the assessment of 21-22. Compute the income of X for the assessment year 21-22. So first of all, they are asking you to compute the total income. Can you tell me there are how many heads of income here? Yes. How many heads of income are involved? Two heads of income. Income from salary and income from income from salary and income from other sources. Sarvana, you also have income from other sources. 1,46,000 is given to you. So, income from salary, what is the monthly salary? What is the amount of monthly salary? 1 lakh rupees. So, what will be yearly amount? 12 lakhs. Correct. This 12 lakhs will become fully taxable to you. Under that income from salary. What else will become taxable? Can you tell me what else will become taxable? Yes. Not IFOs. I am talking about the salary head only. In income from salary head, what else will become taxable? Employer contribution. Very good. Employer contribution. 15%. So what is that amount? 15%. 15% of how much? 15% of 1 lakh. That is 15,000. So what is the yearly contribution? 1,80,000. This 1,80,000 will also become taxable under income from salary. Yes or no? Okay. So what is the amount of your gross salary? What is the amount of your gross salary? 1 lakh rupees multiplied by 12, that is 12 lakhs. Plus 15,000 multiplied by 12, that is 1,80,000. So total is 13,80,000. This will be the amount of gross salary. This will be the amount of gross salary. From that you can claim standard deduction. From that you can claim standard deduction. What will be the amount of standard deduction? Yes, 50,000 rupees. Very good. So what will be the amount of income from salary for you? What will be the amount of income from salary? 13,30,000. Correct. 13,30,000. Now tell me, what is the amount of income from other sources? One 146. So what will be the amount of gross total income? What will be the amount of gross total income? 14,76,000. 14,76,000 is the correct amount. From that gross total income, what is the amount of deduction under section 80C? What is the amount of deduction under section 80C? 70,000. Very good. 70,000. What is the amount of deduction under section 80 triple C? 12,000 rupees. Correct. Plus, what is the amount of deduction under section 80 CCD subsection 1? What is the amount of deduction under section 80 CCD subsection 1? Yes. What is the amount of deduction under section 80 CCD subsection 1? Employees contributing matching amount, na? So how much amount employee might have contributed to the pension scheme? 15,000 per month. Multiply by 12 months. That is 1,80,000. Correct? Yes or no? Yes. Out of 1,80,000, for 50,000 you will claim deduction where? 80 CCD subsection 1B. Correct? So you are left with what amount? In that case, you are left with how much amount? 130. For this 130, you will go to which section? For this 130, you will go to section 80 CCD subsection 1. For this 130, you will go to section 80 CCD subsection 1. And in section 80 CCD subsection 1, your deduction is restricted to how much? 10% of salary. Salary equals to basic salary, DA recognized turnover commission. So what is the basic salary, DA recognized turnover commission here? 12 lakhs. 12 lakhs. Correct? But here, since the employee is a government employee, deduction will not be restricted to 10%, it will be restricted to 14%, because the employee is a government employee. Correct? Now, can you see the word file on the screen? Yes or no? Okay. So I'm writing those amounts here, which you have given me. Salary is 1 lakh per month, multiplied by 12 months, that is 12 lakhs. Contribution by employer towards the notified pension scheme, 15% of 12 lakhs, that is 1,80,000. This is fully taxable to employee. So your gross salary is 13,80,000. From that you claim standard deduction for 50,000 rupees. So your income from salary is 13,30,000. Your income from salary is 13,30,000. You have income from other sources 1,46,000. You have income from other sources 1,46,000. And then your gross total income is 14,76,000. Your gross total income is 14,76,000. This amount you have given me. Then deduction under section 80C, contribution to public provident fund is 70,000 rupees. Deduction under section 80 triple C is given to in the question as 12,000 rupees. Now, deduction under section 80 CCD subsection 1. What is the amount of contribution? 1,80,000. Out of that, you have already taken 50,000 in section 80 CCD subsection 1B. So you are left with only 1,30,000. You are left with 1,30,000. What is 14% of salary? Can you get me the amount 14% of salary? That is 14% of 12 lakhs. 168. 168. So what is lower out of 2 is 130. What is lower out of 2 is 130, correct? So now get me the total 130 plus 70,000 plus 12,000 is 2,12,000. But this reduction will be restricted to 1,50,000. Yes or no? Now, what will be the deduction under section 80CCD subsection 1B? 50,000 rupees. 50,000 rupees. And what will be the deduction under section 80CCD subsection 2? 80CCD subsection 2, you can claim deduction for employer's contribution. Oh, have you realized we have done a mistake here? That 14% is required to be applied only in case of section 80CCD subsection 2. It is not required to be applied in case of section 80CCD subsection 1. So here that would remain at 10%. It will not be 14%. So that 10% will be 1,20,000. So 130 or 120, whichever is lower, 120. So this total amount will be 2 lakhs. 2 lakhs 2,000. Instead of 2,12,000, it will be 2,02,000. And the deduction would be restricted to 1,50,000. Yes, have you understood? See where you can do the mistake, that it is very important for you to realize. 14% by mistake, you should not apply to employees' contribution, you should apply only to employer's contribution. Now you tell me, for employer's contribution deduction to section 80CCD subsection 2 will be how much? What is the actual amount of money contributed? 1,80,000. Yes or no? 14% of salary is how much? 12 lakh into 14%. 1,68,000. So what is the amount of deduction? 1,68,000. Yes. What is the amount of net taxable income in this case? 1476 minus 150 minus 168 minus 50. This will give you how much? 11,08,000. 11,08,000. Have you understood the solution? Now, just give me a few minutes. I'll try to open the CA Institute module if it is available with me. Yes, can you see ICI model appearing on the screen? It is illustration number 4. Similar to what I have shown you. But what they have done? Basic salary 12 lakhs. This question is slightly different. I want to just show you that alternative solution they are giving you. See this. In the alternative, 50,000 can be claimed as reduction in the section 80CCD subsection 1B, and the balance 1,30,000 can be claimed as reduction in section 80CCD subsection 1. So in the main solution, what they have done? One second. Swati madam, can you see our solution copy? Yes. If you want to take a screenshot, you can take, but this file I will be sending you. All the solutions I'll be sending you. Now, in our solution, what I have done, I have taken deduction first in section 80 CCD subsection 1B, and thereafter for the balance in section 80 CCD subsection 1. What ICI has done, they have first claimed deduction in section 80 CCD subsection 1, and then they have claimed under section 80 CCD subsection 1B. Now they are giving a note in the alternative. 50,000 can be claimed as under section 80 CCD subsection 1B. Balance 1,30,000 they can, you can claim deduction in section 80 CCD subsection 1. Have you understood this? So whatever solution they are providing as an alternative solution, that in my opinion is beneficial to SSC, so I am following that. So with this we have completed section 80C. Today we have completed section 80 triple C. We have completed section 80 CCD. In that we saw section 80 CCD subsection 1, 80 CCD subsection 1B, and section 80 CCD subsection 2. We also discussed the solution for question number 1. Yes. So we'll have a break right now. Yes or no? 30 minutes break, correct? Yes. So it is right now 9:12. Right now it is 9:12. We'll have a break up to 9:42. 30 minutes, na? Any one of you are having doubt, you can ask me right now. Rizwan says, sir, section 80 triple C, point number 3. Rizwan, can you see the screen? What is your doubt here? Rizwan, are you there? Can you see the screen? I'm showing you section 80 triple C, point number 3 on screen. First of all, tell me, can you see the screen? Yes. So in this case, what is the doubt? If you partially withdraw money from this pension scheme, then partial withdrawal, if the subscriber is an employee subscriber, he can claim exemption. If the subscriber is a non-employee subscriber, he cannot claim deduction. You wanted 80 CCC. Okay. Yes, tell me. 80 CCD point, 80 CCC. Point number 3 says that payment should be made out of income chargeable to tax. Means this investment you should make from your taxable income. This investment you should make from your taxable income. If you are having an exempt income as well as the taxable income, and if you make investment from your exempt income, then we are not going to give you this deduction. If you want to claim deduction in section 80 triple C, the investment should be made out of taxable income. So we have completed section 80C, section 80 triple C as well as section 80 PCD. Now we'll move on to the next section. That is section 80D. Section 80D, we are on page number 286. See, Section 80D gives deduction for four things. Section 80D is giving deduction for four things. First of all, who can claim deduction? Individual and HUF can claim deduction irrespective of whether they are resident or non-resident. Individual and HUF can claim deduction in Section 80D irrespective of whether they are resident or non-resident. Deduction is allowed for what? Deduction is allowed for following payments. Deduction is allowed for following payments. So there are four payments. For this, deduction will be allowed in Section 80D. Point A, any amount paid as an insurance premium by any mode other than cash. Which insurance premium? Health insurance premium. So number one, you can claim deduction for any health insurance premium paid, provided the condition is payment should be made by any mode other than cash. This is point A. First point. Second point, see, there are certain central government and state government health schemes like employee state insurance scheme, etc. These are the central government and state government health schemes. In that, you have to contribute money every month. It will be deducted from your salary. If you are a government employee, then your contribution towards the central government health scheme or your contribution towards the state government health scheme will be deducted every month from your salary. Thereafter, if you fall ill, then you can get hospitalized and get the treatment. Bill will be paid from the health scheme. You will not be asked to pay anything. So whatever amount you are contributing to central government health scheme, state government health scheme can be claimed as deduction. So number one, if you have taken a health insurance premium, health insurance policy, whatever premium you are paying to health insurance company, that can be claimed as deduction. And number two, whatever amount you have contributed to central government health scheme or state government health scheme, that can also be claimed as deduction. Number three, amount paid on account of preventive health checkup can be claimed as deduction. See, preventive health checkup means even if you are not ill, you should do the normal body checkup once in a year. That is what government feels. Because government believes that, see, in India, the most of the people who are suffering from cancer, they don't survive. They don't survive. The reason is because that when the cancer is detected, they are already at a last stage. When the cancer is detected, they are already at a last stage. So it is very difficult to treat them, provide a treatment even after treatment, whether the treatment will be successful or not, whether their body will be in a position to handle that chemotherapy or not. That is the question. So people generally don't survive after chemotherapy. Very less number of people survive because in their cases, cancer is detected at the last stage. So government says everyone should go under a normal routine body checkup so that if there is something wrong in the body, that can be detected in an initial stage. If it is detected at an initial stage, it can be cured with less amount of money, less amount of pain, less sufferings. So government says we will give you deduction if you are spending money for preventive health checkup. If you are spending money for preventive health checkup, you can claim deduction. See, these hospitals are offering preventive health checkup packages. You pay them 2,000 rupees or 3,000 rupees, they will do 45, 50 different tests for you. So WBC test, RBC test, etc., etc., thyroid test, sugar test, they will do basically around 40, 45 different tests for you, and they will charge you 3,500 rupees. So government says everyone should undergo that preventive health checkup. Whatever expenditure you incur for preventive health checkup, that can be claimed as deduction even if you make payment in cash. Even if you make payment in cash, that can be claimed as deduction. See, amount health insurance premium paid or amount contributed to central government health scheme, state government health scheme, deduction is allowed provided payment is made by any mode other than cash. Cash payments will not be allowed as deduction, but amount paid on account of preventive health checkup can be claimed as deduction even if the payment is in cash. Because generally when you go to hospital for a normal body checkup, you have to pay money in cash only. Therefore, government says in case of preventive health checkup, whatever expenditure you might have incurred, you can claim it as deduction in section 80D even if the payment is made in cash. Point 4. Point 4 talks about a medical expenditure. Medical expenditure means someone has fallen ill. He is either hospitalized or not hospitalized, but expenditure is incurred for his treatment. And he is a senior citizen person. Plus, he is not having any health insurance policy. This point was inserted just before 3-4 years because government realized that in India, most of the people do not have the health insurance policies. And senior citizen people, they fall sick, they fall ill and they get hospitalized. For them, section 80D is not offering any deduction. Therefore, government came out with point number D. Now, if there is a senior citizen, he is undergoing any medical treatment, whatever expenditure is incurred, you can claim it as deduction, provided there is no health insurance policy. This payment should be made by any mode other than cash. So there are 4 expenditure for which you can claim deduction in section 80D. I repeat once again. Number 1, health insurance premium paid. Number 2, amount contributed to central government health scheme and state government health scheme. Number 3, amount paid on account of preventive health checkup. And number 4, medical expenditure incurred in respect of a senior citizen not having health insurance policy. Out of 4 points A, B, C, D, point number D, point number A, B, and D, payment should be made by any mode other than cash. Point number C, we can make payment in cash or other than cash, everything is okay. Once again, in section 80D, we are having same point which you saw in section 80CCC. If you recollect, in section 80CCC, I told you that this point is very difficult to verify. It says payment should be made out of income chargeable to tax. Whatever payment of premium, etc., you are making should be made out of income. First of all, for understanding the maximum limit, for deduction, we can divide the SSA into 2 categories. We can divide the SSA into how many categories? 2 categories. Individual and HUF. First of all, individual can claim deduction for whom? Individual can claim deduction for self, spouse, and dependent children. He can claim deduction for number one self, number two spouse, and number three dependent children. In other words, he cannot claim deduction for an independent child. If you recollect, in section 80C, you can claim deduction for self, spouse, and children, irrespective of whether the child is dependent, independent, married, unmarried, minor, major, male, female, sound mind, unsound mind. Don't look at the variety of children when it comes to section 80C. But here in section 80D, you can claim deduction for your child only if he is dependent on you. In other words, you cannot claim deduction for an independent child. Now what will happen now? You know that deduction is allowed for dependent child, but you don't remember where dependent child what was written. Was it written in section 80C or was it written in section 80D? That you don't remember properly. Therefore, examiner would try to take advantage of this and he would ask you a point in the question saying that Mr. X has paid life insurance premium for his dependent child. In that case, definitely you can claim deduction. But to confuse you, he will say life insurance premium is paid for independent child. He will say that life insurance premium is paid for independent child. Now, if you instead of correlating with section 80C, if you try to correlate that with section 80D, then your answer will go wrong. Because section 80C they have clearly mentioned that deduction can be claimed only for a dependent child. For independent child, you can't claim deduction. Dixit, for railway employees, there are railway hospitals. So they might be getting some treatment there. Point is, whatever free treatment they have got, in income from salaries chapter, that free treatment is exempt from tax. If you recollect the chapter of income from salary, medical facility point, I had explained you that if you have got a free treatment in the hospital maintained by employer, that cost incurred by employer is totally exempt from tax. Here, can you claim deduction? Answer is no, because you are not paying anything now. Neither it is a medical insurance premium, nor amount contributed to central government, state government health scheme, nor it is a preventive health checkup, and nor it is a medical expenditure in respect of senior citizen. If it is a senior citizen, he would have retired by that age. So here you can't claim deduction. Yes, shall I proceed further? Individual can claim deduction for number one, self, spouse, and dependent child. You can write G1 into the bracket here. Next to the word self, on the left hand side, you can write G1 in the bracket. G1 means group 1. G1 means group 1. Those people for which an individual can claim deduction, we can divide those people into two categories, group 1 and group 2. Group 1 includes 3 persons. Number 1, self, number 2, spouse, and number 3, dependent children. And group 2 includes parents. Group 2 includes parents, irrespective of whether they are dependent or independent. Now see, very important point to be noted is section 80C deduction is not available if you make investment or incur expenditure for the benefit of your parents, brothers and sisters. But when it comes to section 80D, government is giving you deduction if you have incurred expenditure for your parents. because chances of your parents falling ill is more than your chances of falling ill. Therefore, government has covered parents also in this section 80D. Ramya is asking me, sir, whether parents will include spouses' parents. Answer is no. This is only your own parents. See, if your spouse is a income earning person, spouse is a earning member, then she can claim deduction for her parents in her own income tax return. But here, only SSC's parents are covered. Is that very clear? So individual can claim deduction for group 1, group 2. Group 1 includes self, spouse and dependent children. Group 2 includes parents, whether they are dependent or not. HUF can claim deduction in respect of expenditure incurred or contribution made for any member of family. For any member of family. Now, very important point to be noted is, I have told you now, I told you in this point number 2, I explained you that you can claim deduction for 4 things. Out of these 4 things now, we are making group. Point number A, B and C, we will put in group A, and point number D, we will put in group B. Means we are taking up the aggregate of point number A, B and C. This 3 expenditure, if you add whatever amount you get, that amount should be compared with the maximum limit. What is the maximum limit? Maximum limit is 25,000. Maximum limit is 25,000 for group 1 and 25,000 for group 2. What do you mean by group 1? Group 1 means self, spouse and dependent child, and group 2 means parents. So there is a 25,000 limit of group 1 and 25,000 limit of group 2. See, health insurance premium, everyone. But for this amount contributed to central government, state government health scheme, you can't claim deduction for parents. See, anyway, practically no one contributes because this amount is deducted from employee's salary, and by default, this is for self, spouse, and children only. For parents, the amount is not getting deducted from salary only. A person who is doing job now, his family is covered. His family means his spouse and his children. Therefore, this point, in fact, forget about not eligible. This is not applicable only. This is not applicable only. Have you understood this? Yes or no? Okay, let us proceed further. Once again, I am repeating. Health insurance premium amount contributed to central government health scheme, state government health scheme, amount paid for preventive health checkup. The combined deduction for group 1 is 25,000, for group 2 is also 25,000. HUF can claim deduction 25,000 separately. So I have an example in front of me. I'll show you the example. You should give me the answer as to how much deduction will be allowed. Yes, can you see example number 1? In this, say for example, employee has paid health insurance premium. He has paid what? Health insurance premium for group 1 as well as group 2. In group 1, he has paid 10,000 for self, 10,000 for spouse, 10,000 for dependent child, 10,000 for father, and 10,000 for mother in group 2. How much deduction he will be eligible to claim? Yes. According to your understanding, he can claim how much deduction? I got the answer from 2 people, 3 persons, out of which 2 answers are wrong. What about others who don't want to give the answer? Will directly give the wrong answer in the examination. Yes. Deva has given the correct answer and Dixit has also given the correct answer. Shruti has given the correct answer. All other answers are wrong. You should give the both answer, na? So answer is here. You can't claim deduction for 50,000. You can't claim deduction for 50,000 because the limits which are applicable, they are applicable separately for group 1 and separately for group 2. This 25,000 is a limit applicable for group 1. This 25,000 is a limit applicable for group 2. You cannot apply this limit on an overall basis. You have to apply the limit group wise. So if you look at group 1, the health insurance premium paid is 30,000, but maximum deduction would be 25,000 in case of group 1. Look at group 2, actual premium paid is 20,000 and the limit is 25. Deduction will be allowed for whichever is lower amount. Have you understood? So limit of group 1 cannot be utilized in group 2. Limit of group 2 cannot be utilized in group 1. This interchangeability of limit is not allowed. Interchangeability of limit is not allowed. So the deduction here will be 45,000. For group 1, 25,000. For group 2, 20,000. Now listen to me. We are reading this additional point. Additional deduction for point small a. What is point small a? Health insurance premium. Health insurance premium. See, this 25,000 is the limit for all the 3 points combined A, B, and C. This 25,000 is the limit for all the 3 points combined A, B, and C. But we are saying that you will get extra deduction of 25,000 for health insurance premium in case the policy is taken for a senior citizen. In case the policy is taken for a senior citizen, we will give you extra limit of 25,000. but this is only for point small a, that is health insurance premium. In other words, this limit 25,000 is an extra limit, but this is not for amount contributed to central government and state government health scheme. This is not for preventive health checkup. This is there only for medical insurance premium, health insurance premium. This is there only for senior citizen, not for everyone. So, if anyone in a group, if any person in the group is a senior citizen, then you will get extra 25,000 limit. And very important point to be noted is this extra 25,000 limit can be used only for the benefit of senior citizen. This extra 25,000 limit can be used only for the benefit of senior citizen. Have you understood this point? Yes or no? Yes. So you get extra limit of 25,000 for group 1 also, extra limit of 25,000 for group 2 also. What is the condition? You might have, you should have paid health insurance premium for a senior citizen, then you get extra limit of 25. And very important point to be noted is this extra limit of 25 can be used only for the benefit of a senior citizen. I am now giving you example number 2. So there is the example number 2 in front of you. Refer this and give me the amount of deduction. Do we have Manoj? Manoj? See, example 2 is only on group 1. Example 2 is only on group 1. Group 1, self age is 58 years, spouse age is 62 years, dependent child age is 20 years. Health insurance premium is paid for self for 21,000, for spouse 18,000, for dependent child 21,000. How much reduction will be allowed? I've got multiple answers. Akash says that deduction of 60,000 will be allowed. 3-4 people are saying that deduction of 5050 will be allowed. There are few people saying that deduction of 43,000 will be allowed. See, first of all, please understand. Normal limit is only 25,000. Normal limit is only 25,000. Extra limit is 25. That extra limit of 25 is only for the benefit of senior citizen. In this normal limit, who all are covered? In this normal limit of 25,000, who all are covered? Senior citizen or non-senior citizen or both? In this normal limit of 25,000, senior, non-senior both are covered. In extra limit of 25,000, only senior is covered. Senior citizen bogie. In general bogie, who can travel? Senior citizen as well as non-senior citizen. In special bogie, who can travel? Only senior citizen. First of all, what you should do now? Whatever your premium you have paid now, you should try to take advantage of general bogie. You should try to take the advantage of general bogie. But if there is someone who is a senior citizen now, then first you should put that health insurance premium in special bogie of senior citizen. Special bogie of senior citizen, so that general bogie limit is not exhausted. General bogie limit can be utilized for the benefit of non-senior. In this example, can you tell me what is the expenditure, health insurance premium expenditure incurred for non-senior? Who is non-senior? Self is non-senior, 21,000. Dependent child is non-senior. You are also 21,000. Self 21, dependent child 21. Yes, total 42. This will form part of which bogie? General bogie. What is the limit for general bogie? 25. So what will be the deduction allowed for general bogie? 25. Yes, is that very clear? Yes. Thereafter, we are giving you extra deduction of 25,000 for senior citizen. But in case of senior citizen, here we are having an amount of only 18,000. So claim the deduction of 18,000 here in special bogie. Actual expenditure 18, limit is 25, deduction will be 18. So from the general bogie, you claim deduction for 25,000. From the special bogie, which is only for a senior citizen, you claim deduction for 18,000. So 25 plus 18, it is 33,000. 25 plus 18 is 33,000. Yes, have you understood this very clearly? In other words, in general bogie, senior citizen can take advantage. In extra amount of 25,000, non-senior cannot come. Senior can go wherever he wants. Non-senior is just can take the advantage only in general limit of 25. In case of self 2000, children 2000, general deduction 22. Rizwan, by mistake somewhere you have written 2000 instead of 20,000. In self you have written 2000, in child you have written 2000, total you have taken as 22,000. So somewhere by mistake you have put it 10 less somewhere. But considering that for self it is 20,000, for child it is 2,000, can you claim deduction for 22,000? Answer is yes. You can claim deduction for 22,000. Rizwan, understood? Yes or no? Okay. So now let us proceed further. In this table, this is general limit of 25,000 in case of group 1, general limit of 25,000 in case of group 2. If anyone is a senior citizen in group 1, you get an extra limit of 25,000. That extra limit of 25,000 can be used only for senior citizen. If anyone is a senior citizen in group 2, then you get extra limit of 25,000 for group 2. That extra limit can be claimed only for the benefit of senior citizen. And that extra limit is only for health insurance premium. So question number 2 I have explained. Example 2 is over. I am giving you example number 3. Now can you tell me what will be the amount of deduction? In example 3, what will be the amount of deduction? Yes. Example 3, how much will be the amount of deduction? I've got three answers: 47,000, 48,000, 27,000, 50,000. Why so many answers? See, this 21,000 is part of general bogie, correct? This 21 is part of general bogie. This 2 is also part of general bogie. So out of total 50,000, how much is part of general bogie? 23,000. 23,000 is part of general bogie. What is the limit of general bogie? What is the limit of general bogie? 25. So definitely you can claim deduction for this 23. You can claim deduction for this 21. You can also claim deduction for this 2. In general bogie, there is a sufficient balance, sufficient limit of 25. You can claim deduction for 21 plus 2, there is 23. After claiming deduction of 23,000 in general bogie, what is the unexhausted limit? Yes, out of 25,000, 23,000 is the exhausted limit. What remains unexhausted is 2,000. What remains unexhausted is 2,000. That 2,000, can you utilize the limit for senior citizen? That 2,000 limit, can you utilize for senior citizen? Yes, because in general bogie, in limit of 25,000, there is senior as well as non-senior. So out of this 27,000, which is incurred only for senior, 2,000 I will take to the general bogie, because I am having a limit left in general bogie. Yes or no? General bogie limit is 25, out of which 21 is for self, 2,000 is for dependent child. So out of 25, 23,000 limit is exhausted, but still we are left with limit of 2,000, which is unexhausted. In that 2,000, you can take deduction with respect to amount spent for spouse, that is senior citizen. 2,000 you can take to general bogie. Thereafter, how much will be left? Out of 25, out of 27,000, how much will be left is 25. That 25 you can take it to special bogie. That 25 you can take it to special bogie. Deva, have you understood? So what will be the amount of deduction? Tell me. Out of this 50, how much will take to general bogie? 25. How much will take to special bogie? There also 25. So amount spent for senior citizen 27,000 will be bifurcated in two parts. 2,000 will be taken to general bogie, 25 will be taken to special bogie. So your correct amount of deduction here is 50,000. Correct amount of deduction here is 50,000. Yes, have you all understood this very clearly? So here we are saying that for non-senior 23,000, for senior 2,000, total 5,000. This is general bogie. Special bogie, only senior citizen 25,000. Total deduction 50. Total deduction is 50. So I have explained you that this 25,000 extra limit is available only for a senior citizen, only for health insurance premium paid, and this limit should be exclusively used for the benefit of senior citizen only. For non-senior, you cannot utilize this extra limit of 25,000. In case of HUF, also original limit is 25, but if any member of HUF is a senior citizen, then extra 25 limit will be given. Extra 25 limit will be given. Now we move on to second point, that is capital B. Second point is covering the fourth expenditure. Second point is covering the fourth expenditure. What is fourth expenditure out of four? Fourth expenditure is medical expenditure on the health of a person who is a senior citizen, provided there is no health insurance policy. Medical expenditure on the health of a senior citizen, provided there is no health insurance policy. What is the maximum limit for deduction? 50,000 for group 1, 50,000 for group 2, and 50,000 in case of HF. Yes. Have you understood point number B? Yes or no? Okay. Now see, listen to me very carefully. 80D is giving you deduction for 4 points. Small a, small b, small c, small d. First 3 points. Small a, small b, small c. Health insurance premium, amount contributed to central government, state government health scheme, and medical expenditure incurred in respect of senior citizen not having health insurance. For these 3 points, there is a limit of 25. If any person in a group is a senior citizen, you get an extra limit of 25. For this fourth expenditure, medical expenditure incurred on the health of employee, on the health of a person who is a senior citizen, this point is kept separate. For this, you are having an extra deduction limit of 50,000. For this, you are having an extra deduction limit of 60,000 rupees. 50,000, 50. So, point B, you can claim deduction of maximum 50,000. What is point B? Medical expenditure incurred in respect of a senior citizen. Now I am telling you the maximum deduction for A plus B combined. A plus B means capital A plus capital B. Maximum deduction for capital A plus capital B combined should not exceed 50,000. Should not exceed 50,000. Have you understood this? Yes or no? Yes? Okay. So maximum deduction for point number A and B combined should not exceed 50,000 for group 1, 50,000 for group 2, and also 50,000 in case of HF. Also 50,000 in case of HF. Now let me give you some important points. Important point number 1. What do you mean by senior citizen? Senior citizen means a person who is at least 60 years of age plus he is resident in India. Senior citizen means a person who is at least 60 years of age plus he is resident in India. If he is non-resident, then we will not consider him as senior citizen, even if his or her age is more than 60. So senior citizen means an individual who is at least 60 years of age at any time during the previous year. Which type of individual? Resident individual. Resident individual. So this is important point number 1. Important point number 2. See here, in case of individual, you can claim deduction for Deva 50,000. Why it will exclude the extra deduction? Why it will exclude the extra deduction? Extra deduction for 25. Extra deduction is already included here. 9 point number A. Yes or no? So point number A, normal limit is 25. extra limit is 50. So point number A also, your deduction can be to the tune of 50,000. Point number B also, your deduction can be to the tune of 50,000. And then we are saying that combined deduction for point A and point B, that is capital A, capital B, should be 50. In other words, you can claim deduction of maximum 50,000 in case of group 1, maximum 50,000 in case of group 2. Then HUF also can claim deduction of maximum 50,000. Is that very, very clear? Okay, now listen to me very carefully. See, in this original limit of 25,000, this is called a general limit. In this general limit of 25,000, amount spent for preventive health checkup is covered now. In that general limit of 25,000, amount spent for preventive health checkup is covered, right? Amount spent for preventive health checkup is covered in that general limit of 25,000. But we are saying that maximum deduction for preventive health checkup can be 5,000. Maximum deduction for preventive health checkup can be how much? 5,000, and that too, that 5,000 is the limit for group 1 and group 2 combined. See, this 25,000 was a separate limit for group 1, separate limit for group 2. But we are saying that out of this limit of 25,000, you can utilize for preventive health checkup maximum to the tune of 5,000. And that too, that 5,000 is for group 1 and group 2 combined. Have you understood? Yes or no? The aggregate amount of deduction on account preventive health checkup of self, spouse, dependent children, father and mother cannot exceed 5,000. This 5,000 is not a separate limit. This 5,000 is not an extra limit for preventive health checkup. That 5,000 is part and parcel of this 25,000. 5,000 is part and parcel of 25,000. Is that very, very clear? Yes. Let us try to take an example very quickly. Example number 4. Give me the answer. Health insurance premium plus amount spent for preventive health checkup combined. Health insurance premium plus amount spent for preventive health checkup combined. Health insurance premium plus amount spent for preventive health checkup combined. I am talking only about group 1. Health insurance premium for self is 9,000, for spouse is 60. Spouse's age is 62,000, senior citizen, and amount spent for health insurance premium is 23,000. For children, amount spent is 9,000, total 41,000. Plus preventive health checkup incurred for self, spouse, children, all of them 3,000 each, that is 9,000. So your health insurance premium is 41, preventive health checkup is 9. So what will be the total deduction? You have spent 50,000. You can claim deduction for maximum how much? Yes. $46,000. This preventive health checkup actual expenditure increase 9,000. That will be restricted to 5,000. That will be restricted to 5,000. Correct? Rizwan, even if SSC is non-resident, deduction is allowed. Even if SSC is non-resident, deduction is allowed. But in that case, In that case, if the SSC is a senior citizen and non-resident, then we will not give him some extra limit. That extra limit of 25 will not be given to him. So most of you are giving the same answer, 46,000. So that is the correct amount. See, first of all, this preventive health checkup of 9,000 incurred should be restricted to 5,000. Then out of the balance, this 23 na, amount spent for senior citizen. This you can take in that additional limit of 25. This you can claim it in additional limit of 25. And then we have a general limit of 25. We have a general limit of 25. Out of that 25, 5,000 is already taken to preventive health checkup. So we are left with how much? 20. And the health insurance premium for self and dependent child does not exceed 20. It is only 18,000. So health insurance premium for if we fall ill, then they will pay the hospitalization cost. But what if we do not fall ill? In that case, if we do not fall ill, in that case, whatever premium we might have paid will be gone now. That is a loss for us. So, health insurance companies generally come out with a temptive scheme. So, for example, health insurance company, for example, Manoj is taking health insurance policy for himself, his spouse, and his children. Now, say for example, insurance company has asked for the premium of 30,000 per month, sorry, per annum. For per annum, insurance company has asked the premium of 30,000. Manoj says this premium is too high, I cannot afford, I don't want the health insurance policy, go from here. So Manoj is asking that agent to go saying that I cannot afford the premium of 30,000 per annum. Now, what that insurance company will do now? Insurance company will say that yearly premium is 30,000, but if you pay for 2 years combined, in that case we will offer you discount. For year it is 30,000, so for 2 years it is 60,000. Now you pay at one go for both the years combined. Then in that case, instead of now, for example, you have paid premium of 25,000 for 2 years. You have paid a premium of 25,000 for 2 years. Can you claim deduction for entire 25 in the first year itself? Answer is no. If you have paid the premium for 2 years, then divide the amount of premium in two parts. If you have paid the premium for 2 years combined, in that case, the amount of premium should be divided by 2 and it should be equally taken into both the years. If you have paid the premium for 3 years combined, in that case, amount should be bifurcated in 3 parts and every year you should take part amount. Have you understood this? Yes or no? Yes. Now I am giving you around 1 minute's time. Kindly refer to question number 2 and give me the amount of deduction. What will be the deduction available in case of question 2? Read this question, give me the amount of deduction. Yes, Dikshit has given me the answer 75,000. Yes, shall I proceed? Okay. Let me read the question. During the previous year 2021 X, Mr. X, age 29 years, pays the following amount by check to get the tax benefit. For self and spouse, health insurance premium paid for self and spouse is 20,000. Amount contributed to central government health scheme is 3,600. Amount spent for preventive health checkup expenditure of self and spouse, this is 3,000. Amount paid for parents of taxpayer, health insurance premium for father 30,000. Age is 67 years. Father is resident and independent. Parents are irrespective of whether the parents are resident or non-resident, independent or dependent, you can claim deduction for them. Medical expenditure for mother not having health insurance. At medical expenditure, you know, na, deduction is allowed up to 50,000. Preventive health checkup for mother 4,000. Others, amount spent for grandparents, father of Mrs. X and brother dependent on X. For these people, you cannot claim any deduction. Now, first of all, let us see what is the amount of preventive health checkup. 4 plus 3, 7. So, out of this 7, deduction would be restricted to 5. Deduction will be restricted to 5. This 30,000 can be claimed as deduction entirely. Because in that general limit, you can claim deduction for senior as well as non-senior. So, general limit is 25. In that, you claim deduction for 25. And remaining 5, you claim it as deduction as part of extra limit of 25, which is applicable only in case of senior citizen. Capital B, medical expenditure, you claim deduction for entire 30,000. But you know that capital A plus capital B cannot exceed 50. Preventive health checkup cannot exceed 5. Plus health insurance premium paid for self, spouse, children and amount contributed to central and state government health scheme cannot exceed 25,000 for group 1. So in this case, we have to decide. See, for this group 1, your deduction should be restricted to 25,000. Out of 25,000, if you take the first two amounts, anyway, it is turning out to 23,600. So out of 25, limit of 23,600 is exhausted here. So from preventive health checkup, you take only 1,400. You take only 1,400. So this group 1 now you can claim deduction for 25,000. Group 1 you can claim deduction for 25,000. Have you understood this? Group 1 25,000 you can claim deduction. Parents of taxpayer group 2 for health insurance premium, normal limit 25. including preventive health checkup. Special limit extra 25 and medical expenditure 50, but total cannot exceed 50. Premium plus the medical expenditure cannot exceed 5050. So see here in group 1, out of 3000 preventive health checkup, we had taken how much? 1400. So out of the total limit of 5000 which is applicable in case of preventive health checkup, 1400 is exhausted. So balance 3600 you can use here. So out of this 4000 now, out of this 4000 you can claim 3600 for preventive health checkup. Yes or no? Out of 4000, 3600 you can claim deduction for preventive health checkup. Out of 4000 you can claim deduction for preventive health checkup 3600. Plus this 30 is how much? 33600. 33600 plus this 30 is how much? 63600. But that will be restricted to 5050. 5050. So for group 1, 25,000. For group 2 parents, 50,000. So total is 75. Total is 75. Have you understood this? Rizwan has not understood. Rizwan, can you tell me out of this group 1 how much deduction will be available? For this group 1, what will be the amount of deduction? 25. Okay. In that 25, for how much amount you claim deduction in case of preventive health checkup? Out of 25,000, preventive health checkup you claim deduction how much? Rizwan? 1400 na, Rizwan. Now, can you see the screen? First of all, tell me, can you see the screen? Pollution. Rizwan, the category है insured person being SSC, spouse and dependent children. Health insurance premium paid for self and spouse 20,000. Amount contributed to central government health scheme 3,600. Preventive health checkup 3,000. Total expenditure is 26,600. Deduction will be restricted to 25. Deduction will be restricted to 25. Do you have any doubt in this? No, very good. Point B. Medical expenditure for a senior citizen. Senior citizen father 30,000. Sorry, medical premium, not medical expenditure. Medical premium, health insurance premium. Medical expenditure of mother not having health insurance 30,000. For that you can claim deduction capital B point na, this one. For premium paid for father, you can claim deduction in point capital A. Point capital A normal limit is 25. In case of senior citizen, you get extra limit of 25. Normal limit is 25. In case of senior citizen, you get an extra limit of 25. So combined limit will be 50. Normal limit 25. Senior citizen extra limit 25. Total will be 5050. Out of that 50, how much you can utilize? 30,000 for health insurance, and for preventive health checkup, how much you can utilize? Preventive health checkup, there is a limit of 5,000 now. Out of that 5,000 already you have utilized in group 1 now. How much? 1,400. So you are left with 3,600. This one, are you understanding? This one here in group 1. Here in group 1, see highlighted part. Here we have claimed a deduction of 25,000 only. Total expenditure was 26,600 na. We claimed deduction for 25. So in that 25, I am saying that health insurance premium is 20. Amount contributed to central government, state government health scheme is 3,600. So what is balance left? 1,400. Yes or no, Rizwan? Okay. Now you tell me what is the limit for preventive health checkup? 5,000. Out of which 1,400 you have utilized in group A. 1,400 you have utilized in group A. So what is the balance left? 3,600 na. This one. So in this group B, preventive health checkup expenditure for mother is 4,000. But you can't claim deduction for 4,000. Your deduction will be restricted to 3,600. Is that very clear? Okay. Now medical premium paid for father 30,000. There the normal limit is 25, and since he is a senior citizen, extra limit 25. So total limit is 50, but the premium is only 30,30. 30 plus preventive health checkup 3,600. And for medical expenditure in respect of mother, there is a separate limit now 50,000. In capital B, here. And then we are saying that capital A plus capital B combined cannot exceed 50. So here everything combined is 64. That will be restricted to 50. Yes. Yes. So here point A, part 1, group 1, 25,000 limit. Group 2, 50,000. Total deduction is 25. And very important point, deduction is not allowed for expenditure incurred for grandparents of X, father of Mrs. X, and brother of X. Parvez is asking me, sir, A plus B is 50. Yes, A plus B is 50. Parvez, A plus B is 50. That is what is written here. In point number C, we have written A plus B cannot exceed 50. So with this, our exhaustive discussion with respect to section 80D comes to an end. This is the maximum number of examples which I can give you. For explaining you every point, I have taken a numerical example. I don't think that we will get a more exhaustive understanding anywhere. All the varieties of examples are covered. So question number 2 is also over. Now we move on to section 80DD. Along with section 80DD, I will also discuss section 80U. Along with section 80DD, I am also going to discuss section 80U with you. Now listen to me carefully. Deva, maximum limit for A plus B is 50,000, yes. Are you asking me then why you are claiming deduction of 75 years? Is that your question? Madam, please don't get confused. Let me change it. In the solution sheet, let me change the serial number. Let me make this as 1. This is group 1. This is group 2. Let me make it as 1 plus 2. You unnecessarily don't get confusion in A and B. See, now you look at this. First of all, tell me, for group 1, how much deduction you are claiming? 25,000, correct? Deva madam, for group 1, we are claiming 25. Group 2, we are claiming 50,000 deduction. In that, you have capital A as well as capital B. Capital A is combination of medical insurance premium amount contributed to central government, state government health scheme, and amount for preventive health checkup. Capital B is medical expenditure in respect of a senior citizen not having health insurance. So A as well as B combined for group 2 is 50,000. So my deduction for group 1 and group 2 combined is 75,000. Now is that very clear? Yes, actually you are taking this A and you are trying to connect this with the capital A given in the notes. Okay. Now let's move on to next section, section 80 double D. And at the same time, we will also discuss section 80 U. We'll discuss two sections at the same time. One is section 80 double D, the other one is section 80 U. Now listen to me carefully. This section 80 double D is deduction for what? And section 80 U is deduction for what? What is the difference between these two sections? See, section 80 double D as well as section 80 U, both are giving deduction for disability. 80 double D is giving you deduction for maintenance and medical treatment of dependent disabled person. If there is a disabled person and that disabled person is dependent on you, if there is a disabled person and if that disabled person is dependent on you and you have incurred money for his medical treatment or for his maintenance, then you can claim deduction in section 80 double D. 80 double D is a payment based deduction. You will have to incur the expenditure for claiming deduction. If you don't incur the expenditure for maintenance or medical treatment of your disabled dependent person, then you can't claim deduction. Deduction will be allowed only if you have incurred some actual expenditure. This is section 80D. Then we have section 80U. Section 80U also is a deduction for a disability. But section 80U is a deduction for SSE himself. Section 80 double D is a deduction for a dependent person. For example, if I am disabled person, I can claim deduction for myself in which section? Section 80U. But if my dependent persons are disabled, then for them I can claim deduction in section 80 double D. So if we try to make the comparison between section 80 double D and 80U, we can identify few points. Point number 1, 80 double D, you can claim deduction for others. Other means those who are dependent on you. This dependent would include number 1 spouse, number 2 children, number 3 parents, number 4 brother, and number 5 sister. Let me remind you, in section 80C, you can claim deduction only for self, spouse, and children. In section 80C, you can claim deduction only for self, spouse and children. In section 80D, you can claim deduction for self, spouse, dependent children and parents. Because your parents' chances of falling ill is more as compared to your chances of falling ill. Therefore, in section 80D, government had covered parents. Now here, the person is suffering from disability. Person is suffering for disability, so government is having soft corner for those people. So government says will allow you deduction for your brother as well as sister. So in 80 double D, you can claim deduction for dependent spouse, dependent children, dependent parents, dependent brother and dependent sister. In section 80 double D, you can claim deduction for dependent spouse, dependent children, dependent parents, dependent brother and dependent sister. If you yourself are disabled, then for yourself you have to go to section 80U. If you want to claim deduction for yourself, you have to go to which section? Section 80U. Section 80U falls in a residuary category. See, at the beginning of the chapter, I had told you that we are dividing the chapter 6 deduction into three categories. Number 1, payment based deduction. Number 2, income based deduction. And number 3, other deduction. Section 80U forms part of other deduction. Section 80U forms part of other deduction. In other words, in case of section 80U, you will get deduction even if you have not spent money. In case of section 80U, even if you don't spend a single rupee, you will get deduction. But in case of section 80 double D, since this is a payment based deduction, you have to spend money. If you don't spend money, no deduction. Have you first of all understood the difference between section 80 double D and section 80U? Yes. So there, I have given you two distinction points here. I have given you two distinction points. Number 1, section 80 double D, you can claim dependent for you can claim deduction for dependent spouse, dependent children, dependent parents, dependent brother as well as dependent sister. Brother sister means real brother, real sister, not the cousin ones. And if you yourself are disabled, for you can go to section 80U. This is the first point of distinction. Second point of distinction, 80 double D is a payment based deduction. So you have to make payment, you have to incur expenditure. Expenditure for what? Expenditure for number 1, medical treatment of your disabled dependent person, and number 2, maintenance of that person. So you incur expenditure, you are eligible to claim deduction. If you don't incur expenditure, no deduction. Section 80U doesn't fall into payment based deduction category. It falls into other categories. Means even if you don't spend 1 rupee, then also you will get deduction under section 80. Even if you don't spend a single rupee, you will get deduction under section 80U. Is that very clear? Now let's move on to understand these two sections one by one. First of all, we'll move on to section 80 double D. Eligible assessee. Who can claim deduction? In section 80 double D, who can claim deduction? In section 80 double D, individual and HUF can claim deduction provided they are resident in India. So only resident individual and HUF can claim deduction, irrespective of whether they are ordinarily resident or not ordinarily resident. That will not make any difference. But individual and HUF can claim deduction provided they are resident. If they are non-resident, deduction is not allowed in section 80 double D. Number 2, you have to incur some expenses. What expense you have to incur? You have to incur expense for medical treatment, training or rehabilitation expenditure for a dependent person suffering from disability. See, there are a lot of disabilities wherein there are chances of revival. Say for example, Disability also includes blindness or low vision. If you are having a low vision, that vision can improve. If you do yoga, pranayam, or you have some Ayurvedic medicines, your vision can improve. Or if the doctor is guiding you and is asking you to do some exercise, as a result of which your vision will improve. So that is called as an expenditure incurred for medical treatment, training and rehabilitation. Rehabilitate means to take it to the previous position. Prior to illness. So expenditure incurred on the medical treatment, expenditure incurred on training, and expenditure incurred on rehabilitation. This can be claimed as deduction. Number two, you can deposit money with LIC or any other insurance company or UTI for acquiring a policy in the name of disabled person. The policy should be such that if something happens to you, policy should be such that if something happens to you, then the insurance company will pay money to the dependent for his maintenance. Say, for example, my brother is disabled person. He is dependent on me. The number one, I can spend money for his medical treatment, training and rehabilitation. And number two, I can take some life insurance policy. I can go to LIC of India. I can take some life insurance policy, which is specifically for a disabled person. Thereafter, if something happens to me, then Life Insurance Corporation of India will give money to my brother so that his maintenance can be incurred. He can spend money and he can live his life. So in section 80DD, we are saying that for claiming deduction, you have to incur the expenditure. If you don't incur the expenditure, you are not going to get any deduction. Spending money is very important. If you don't spend, no deduction. Point number 3, what is the quantum of deduction? What is the quantum of deduction? What is the amount of deduction? In this section, the amount of deduction, is fixed. It is not decided based on the expenditure incurred by you. You may incur more expenditure, you may incur less expenditure. Your deduction will remain the same. Your amount of deduction is certain percentage. Your amount of deduction depends upon the percentage of disability. If the disability is less than 40%, if the disability is less than 40%, then government says we are not going to give you any deduction. Government says if the disability is less than 40%, then there is no need to give any deduction to you. The moment you join CA, because of huge pressure of studying, anyway 5-10% you will also become disabled person, mentally retarded to the extent of 5-10%. So government says entire world is mentally retarded, 5-10% everyone is mentally retarded only. So government says if you are a disabled person up to the extent of 39%, if a person is disabled less than equal to 40%, not less than equal to, exactly less than 40%, that is up to 39%, then government says no deduction. Because anyone would be disabled to the tune of 39%. We are not going to give deduction to that. For that, we will not give deduction. Deduction will be allowed only if the disability is 40% or more. If the disability is 40% or more, but less than 80%, then deduction will be 75,000. If the disability is how much? 40% or more, but less than 80%. Then how much deduction? 75,000. See, this second point will not cover 80%, it will cover only up to 79. Second point will cover 40 or more, but less than 80. Less than 80 means up to 79. From 40 to 79, 75,000 deduction will be allowed. If your disability is 80% or more, If the disability of that dependent person is 80% or more, then he'll be considered to be a severely disabled person. In case of a severely disabled person, your deduction would be 1,25,000. In case of a severely disabled person, deduction will be 1,25,000. Now I move on to the most important point, and that is quantum of deduction is fixed irrespective of actual expenditure. Means in this section, the amount of deduction can be either 0 or 75,000 or 1,25,000. How much expenditure you have incurred is of no relevance. Just few minutes back in point number 2, I have explained you that if you don't incur the expenditure, you will not get deduction. That is correct. But whatever expenditure you incur now, that amount will not be seen. You will get a fixed deduction of either 75,000 or 1,25,000. In other words, say for example, your brother sister is disabled person and is dependent on you. In that case, even if you spend 5,000 rupees for him now, even if you spend 5,000 now, you will get deduction of either 75 or 125 depending upon the extent of disability. If you don't spend, no deduction. If you spend, how much amount is spent is of no relevance. What is relevant in ascertaining the quantum of deduction is extent of disability. If extent of disability is less than 40%, no deduction. 40 or more, less than 80, 75,000 deduction. 80 or more, 1,25,000 deduction. Is that very, very clear? Yes? Point B, you need not remember. Point B defines disability. Disability includes low vision, blindness, leprosy, hearing impairment. As and when your exam approaches, now you will have a hearing impairment. Your mother will shout and call you. You will feel that no one is calling me because you will be engrossed in your books. Locomotor disability, mental illness, mental retardation, autism, cerebral palsy. See, please don't ask me what are these disabilities. You can Google and find out. Anyway, you are not supposed to remember this. Examiner will clearly use the word disability in the exam. That's all. If you come across the word disability, you go to section 80DD. If the dependent person is disabled, if SSC himself is disabled, you go and claim deduction in section 80U. Other conditions. Who is going to tell you this extent of disability? Yes? Who will tell you what is the extent of disability? Will you test at home only? Will you show him fingers, count how many fingers are this? He says, these are 6 fingers. Yes? Out of 10, he can see only 6. Means he is disabled. He is having low vision to the extent of 40%. Is that the way to count? Government says no. This self-testing will not be allowed. Government says you go to a doctor. That doctor will give you a certificate in form number 10IA. The doctor has to give you a certificate in form number 10IA. In that certificate, he will clearly mention the extent of disability, percentage of disability. Based on that, you can claim deduction. That is written in point number A. Point number B. I told you now, you have to incur expenditure either for medical treatment, training and rehabilitation, or you deposit money with LIC, UTI or any other insurance company for the benefit of a dependent person. You take a policy. That policy should provide for payment of annuity or lump sum amount to the dependent person in case of your death. That is what is explained in point number B. The scheme of LIC or any other insurer or UTI should provide for a payment of annuity or a lump sum amount for the benefit of a dependent person in the event of death of individual. or the member of HUF in whose name subscription to the scheme has been made. In other words, if my brother is disabled, he is dependent on me, I should take some policy from the LIC or any other insurance company or UTI, and that policy should be specifically for disabled person. That policy should contain the terms and conditions. If something happens to me, fixed amount of money will be given to my brother or annuity will be given to my brother. Policy should be of such nature that it should provide for payment of annuity or lump sum amount in case of death of a assessor. Now, say for example, I have taken a policy for my brother. If something happens to me, if I die, then insurance company will give annuity to him. What if he dies earlier than me? What if the dependent person dies before the assessee? In that case, assessee will receive money from the insurance company and that entire amount will become taxable to him. In that case, assessee will receive money from the insurance company and entire amount will become taxable to him. That is written in point number C. If the dependent person predecesses the individual. Dependent person predecesses the individual means he dies before the death of individual. He dies before assessee. If the dependent person predecesses the individual or member of HF, then the amount paid or deposited shall be deemed to be the income. Amount paid or amount deposited shall be deemed to be the income of the assessee for the year in which amount is received by the assessee from the insurer. Is that very, very clear? Yes or no? Last point, individual can claim deduction for dependent spouse, dependent children, dependent parents, dependent brother and dependent sister. HUF can claim deduction for any member of family. HUF can claim deduction for any member of family. With this section 80DD is over. 80U also it is similar to that only. What is the change in 80U? I have already told you. In 80U, assessee can claim deduction for himself. If assessee himself is a disabled person, for him he can claim deduction in section 80U. In section 80U, he need not spend money. Even if he does not spend money, even if he does not spend a single rupee, he is entitled to claim the deduction. Deduction depends upon the extent of disability. If the disability is less than 40%, no deduction. If the disability is 40% or more but less than 80%, 75,000 deduction will be allowed. If the disability is 80% or more, it is a case of severe disability. In that case, deduction of 1,25,000 will be allowed. Is that very, very clear? Yes. You have to take a certificate from the medical authority. So you have to go to a doctor. Doctor will provide you the certificate. In that certificate, he will mention the extent of disability. Based on the extent of disability, you claim the deduction. The word disability is defined in Person with Disabilities Act 1995. I already told you, disability would cover what? Disability would cover low vision, blindness, leprosy, hearing impairment, locomotor disability, mental retardation, mental illness, autism, and cerebral palsy. These things are defined in Persons with Disabilities Act. Sarvana is asking me same certificate. Answer is yes. Same certificate, 10IA. Basically, form number you need not remember. You need to just remember that yes, certificate is required to be taken. If certificate is not taken, no deduction. Let me give you the last point. This certificate which you take from the doctor, if it is a permanent disability, then you need not get the certificate every year. Say for example, your dependent person is not having one leg, then it is a permanent disability now. In that case, there is no need to take certificate every year. But there are certain disabilities in case of which there are chances of improvement, there are chances of revival. For example, low vision, etc. So in that case, you have to take certificate from the doctor every year. So with this, we have completed section 80 double D and section 80 ATU. Deva is asking me one question. Deva is asking me one question. Deva says there are two persons, both of them are dependent on me. Deva says that there are two persons, both of them are dependent on me, and both are disabled. And say, for example, both are disabled to the extent of 50%. How much deduction will be allowed to Deva? In that case, will it be 75,000 per person? That is 1,50,000, or deduction of only 75 will be allowed? Yes. Only deduction of 75,000 will be allowed. So this 75,000 should not be counted or considered as per person. If you are having 5 persons and all of them are dependent on you, all of them are disabled, then you cannot claim deduction of 75,000 for each one of them. It is a combined deduction for all the dependents combined. Aggregate is basically you have to take up the aggregate. It is not per person, it is per SSE. Deduction is not per person, deduction is per SSE. Is that very clear? I'll ask one more question to you. Say, for example, Mr. X, Mr. Y, there are two individuals, Mr. X and Mr. Y. There are two individuals, Mr. X and Mrs. X. Both are husband and wife, Mr. X and Mrs. X. Mr. X is disabled, Mrs. X is also disabled. Mr. X, Mrs. X, both are disabled. Now, Mr. X is claiming deduction for himself in section 80U. And then Mr. X says that I want to also claim deduction for my spouse. So he has also claimed deduction for spouse in section 80 double D. Similarly, Mrs. X has claimed a deduction for herself under section 80U, and Mrs. X says my husband is also disabled person. So kindly give me deduction in section 80 double D also. Yes. Can they do this? Can both of them claim double deduction? So if an individual has claimed deduction for himself under section 80U, if an individual has claimed deduction for himself under section 80U, then for that individual, someone else cannot claim deduction under section 80 double D. So if you have claimed deduction for yourself in section 80U, then someone else cannot claim deduction for you. Because if you are claiming deduction for yourself, in that case, you are financially independent, you are having income. In that case, some other person should not claim deduction for you. Let me ask one more question. Say, for example, there are two persons who are dependent on Mr. X. There are two brothers of Mr. X. Both are suffering from disability. Both are dependent on Mr. X. First brother is disabled to the extent of 50%. Second brother is disabled to the extent of 85%. What will be the amount of deduction X would be eligible to claim for. X would be eligible to claim how much deduction? One dependent is suffering from disability to the tune of 75,000. The other disabled is suffering from a disability to the tune of 125. So will it be 75 plus 125? That is 2 lakhs. Answer is no, it won't be 75 plus 125 is 1. I told you earlier also, this amount is not per person. This is per SSE. This is not per dependent. If you are having 5 dependent person, that doesn't mean that your deduction will be 75,000 to 5. Rizwan, have you understood? Rizwan, I am giving an example saying that SSE is Mr. X, an individual. He is having 2 brothers. Both of them are suffering from disability. Both are disabled to the extent of 50-50 percentage. What will be the deduction? Will it be 75 plus 75, 1,50,000? I said no. Why? Because deduction is not per disabled person. Deduction is per SSE. One person can claim deduction of maximum 75,000. This one, have you understood? Now one more example. Mr. X is an individual. He is having 2 brothers. Both of them are disabled. Both are dependent on Mr. X. First brother is suffering from a disability to the extent of 50%, and second brother is suffering from disability to the extent of 85%. In that case, what would be the amount of deduction? Rizwan? For first brother is 75, for second brother is 125. So you claim for the second brother, na, Rizwan? You will get a deduction of 125, na? Because he is disabled to the extent of 85%. Yes? Okay. Shall we complete one more section today? Officially, we were to wind up at 11:30. Actually, we started late, na? Because that session was not started. So we can complete one more section today. Very small section, 80 DDB. Yes? Because the 80 DDB, 80 double D, 80 U, these 3 sections should be covered in the same lecture. So let us cover this section today, 80 double DV, and then we will solve question number 3 and then we'll wind up. Solving question number 3 will not take more than 5 minutes. Explanation of this will take around 12 to 15 minutes. So we need to extend by 15-20 minutes. Are you all okay with that? You don't have second lecture, na? Yes, Dikshit, question 3 I can give you as homework if you want. Question 3 I can give you as homework. But question 3 is based on this section 80 DDB. So we will do what we will do now. I will explain you section 80 DDB, and then question 3 you can try it home as part of homework. Tomorrow you can give me the answer. Or maybe I don't think that every one of you are doing homework. So we can discuss in the class itself. Let it take 5 more minutes. Let's move on to this section 80 DDB. This is deduction for medical treatment of certain specified disease or ailment. See, what is the difference between section 80 double D, 80 U versus section 80 DDB? 80 double D and 80 U, they were giving deduction to you for disability. Disability is something different, and disease is something different. Disability is something different, disease is something different. There is a list of diseases given here: cancer, tuberculosis, AIDS, heart disease, lungs disease, kidney disease. All these are diseases. Those diseases can be cured. Disability, sometimes disability can be cured, sometimes disability cannot be cured. So section 80 double D and section 80U, they are giving you deduction for disability, whereas section 80 DDB is giving you deduction for medical treatment of specified disease or ailment. It is giving you deduction for disease or ailment. Very important point is who can claim deduction. Individual and HUF provided they are resident in India. Only resident person can claim deduction. In other words, if SSC is non-resident, he cannot claim deduction. If SSC is non-resident, he cannot claim deduction. Number two, you can claim deduction for whom? If you are an individual, you can claim deduction for yourself, dependent spouse, dependent children, dependent brother, dependent parent, dependent sister. See, section 80 DDB, everyone is covered. In section 80 double D, dependent spouse, dependent children, dependent parent, dependent brother, and dependent sister were covered. SSC was covered in 80U, but here in section 80 DDB, SSC himself, dependent spouse, dependent children, dependent parent, dependent brother, dependent sister, every one of them is covered. In case of HUF can claim deduction for any member of family. So you cannot claim deduction for your father-in-law, mother-in-law, grandparents, etc. Now, deduction is permissible for what? Deduction is permissible for expenditure incurred for medical treatment of SSC himself or his dependents. This is the format to be followed for computation of deduction. For computation of deduction, you follow this format and you will get the amount of deduction. First point is actual amount spent for treatment of specified disease. First point is what? Whatever actual amount of money you have spent for treatment of disease, that you should write against point number A. Point number B is maximum limit. What is the maximum limit for deduction? Depends upon two factors. Number one, residential status of patient, and number two, age of patient. If patient is a senior citizen as well as resident, then maximum limit for deduction is 1 lakh. What if the patient is a senior citizen but non-resident? Then limit is not 1 lakh, then limit is 40,000 rupees. Bye bye everyone. See you tomorrow morning.